use that project financing, they diluted that provisioning for project finance, and now they are giving small finance banks flexibility to lend.
On that note, on the project financing bit, we have in fact a superb interview lined up this morning. Pradeep Kumar Das, CMD of IREDA, joining in, and that has been one big relief as well. Sir, just let's start by talking about some of these factors.
Yeah, very good morning, and thank you for inviting me here. Can I come to the question? Yeah, what are your questions?
Yeah, no, Mr. Das, good morning, of course. So we want to start it off with all the relaxations that the Reserve Bank of India or the regulator has done last week as well for businesses such as yours, right? The brokerage or the analyst community was very constructive. Any thoughts you want to share on how did you read them?
First of all, when they initially brought the draft guideline 5%, there was a panic in the sector. And if you recollect, even I was in your channel and I have spoken that certainly there will be a deep down stakeholder consultation and all. So not only IREDA, even other stakeholders, we had given our suggestions, and there is a very beautiful way of incorporating the suggestions and coming out with a guideline. See, from 5% now it is 1%. So I don't know whether you are talking that sigh of relief and all. Well, this 1% is quite healthy. The reason is that during construction period, having 1% provision is quite fair. And post commissioning, it is 0.4%. And actually, in IREDA, we have 0.4% provisioning in case of commissioned assets. So as far as we are concerned, in commissioned, we don't have any impact at all. Number one. Number two, doing under construction period 1%, it's a good healthy sign. So there should be some difference between a construction project and a commission project, which was not there earlier in RBI's guidelines as far as the segregation of construction and commission. The guideline was during construction, if it is PPP and commission project, then only you will get 50% risk weightage, otherwise it will be 100%.
So, sir, just trying to make it easy for our viewers to understand, what's the final impact therefore? I mean, how do you see the impact in the current year because of these project finance norms?
Now, see, if you're asking specifically on IREDA,
yes, please.
There will be not much impact. The reason is, as I said, the commissioned asset, we are already having 0.4% provisioning. And in the greenfield assets, unlike other project financing where the gestation period is pretty long, in our case, 6 months to 1.5 years in case of solar and wind, and in case of hydro, it takes 2 to 3 years. And if you are, which we are doing now 0.4%, and if you do 1% during construction period, many of the assets which will be starting this period and then ending in the next quarter and next period, and many of the assets can start and get completed during the same year. So annual basis, some of the assets will not have impact, some assets will be having impact, for which we need to have additional provisioning. But
just to understand that when this 5% guideline came out, some organizations had started provisioning for it. Did you have any provisioning at all?
Not at all.
Okay.
Because we're quite confident that what is true and fair, what is correct, that is to be done.
Oh, wow.
Rumors and hearsay, we are not going to do our accounting or risk management.
So
in renewable project, risk mitigation period is pretty small, and if you handle that well, post commissioning, your assets are generally de-risked. So there is no question of having that kind of 5% provisioning and all.
So just one last point. We've talked about how this is a sigh of relief. You're saying that no major impact because anyway you do not provision for 5%. What is the kind of appetite you're seeing for project financing? Let's understand that side of it.
First, the perception about the project management and project financing and risk management with respect to project financing and project lending, that is going to improve. There will be a disciplined approach that during construction, you have to have X percentage, post commissioning, you will have Y percentage. That is very clearly spelled out, which was not there earlier. My kind of organization is going to be rather benefited because our quality, asset quality, is further going to improve. Because the rating agencies and others, even the auditors and all, when they used to come and look at our financials, they generally tend to carry the inertia of referring to those other organizations who is having 10% in their book renewable or having 20% renewable in their book. They may be gigantic organization and they may be comparing with us in the pure banks and all, which is having retail books. But whereas our kind of organization, which is having 75% minimum project lending and 100% green financing. So therefore, our asset quality is going to further improvise by this process, and the perception about our project development will be much more clear. And I think our investor is going to be more happy with the asset quality what IREDA is carrying and going to carry in the time to come.
Okay. Thank you so much, Mr. Das, for speaking with us. That's IREDA talking about the appetite for project financing. You already saw, positive move on some of these stocks when that provisioning final guideline came out. But another conversation we're having this morning is with Biocon. They have raised funds worth 4,500 crore rupees via QIP. What is the reason for this? What are they planning to do with the funds? What's the strategy ahead? I had a chat with Siddharth Mittal, CEO and MD of Biocon. Siddharth, let's start with the rationale for the fundraise. Debt reduction, of course, but is that the primary reason?
So let me contextualize. We have a bank debt of $1.2 billion. And we have obligations to certain private equity investors of $550 million, which was the funds which we had taken in to fund the acquisition of the business that we acquired from Viatris in 2023. So the proceeds of the QIP is going to be used to repay some of those private equity investors, including ADQ, whom we repaid already in January of 2025. Now we have a repayment obligation to Goldman Sachs for almost $200 million. And then we have two more investors, Kotak and Edelweiss, where there are certain obligations which are going to come up by end of this fiscal. So the cumulative proceeds of roughly $530 million will be used to repay these private equity investors.
What would your debt level sit at post this?
So the debt level will be still at $1.2 billion because we are not repaying any of the bank debt or the bond debt that we had. So we have just basically what we have done is on a fully diluted basis, Biocon would have held 72% of stake in Biocon Biologics. And once we have given the exit to these investors, we would increase our stake to 79% in Biocon Biologics.
Okay. So, one question that comes to mind, and you spoke about Goldman Sachs specifically, would they not have had the options for the conversion of their debentures in Biocon Biologics? Why would they not be exercising that?
So Goldman Sachs had the option. It was an optionally convertible debenture.
Right.
While the other investors, Kotak and Edelweiss, is non-convertible debentures. But coming back to Goldman Sachs, of course, they had an option to convert it into equity. But today we are also we are all aware that some of the headwinds that we had in the last couple of years because of facility issues, not receiving the approvals, and the growth that the business had, that probably influenced their decision to not convert. Of course, I would let Goldman Sachs comment on what was the rationale for redeeming the OCD and not converting. But today, I think I'll move forward and say that we are very well placed. We have addressed a lot of those issues, whether it was relating to facility approvals, whether it was relating to product approvals, whether it was relating to gain in the market share for various products in the US or other markets, and coming back to the growth trajectory. So I think we are very well placed. And I think the QIP or repaying some of these investors, as I mentioned, give us the opportunity to increase our stake in Biocon Biologics, which can then be unlocked at a much better valuation in the future.
Okay, you can watch that entire conversation with Siddharth Mittal ahead on NDTV Profit, but just a few minutes for markets to open. Let's quickly get the big brokerage call of the morning. Harsh standing by. Yes, Harsh, what have you picked?
Well, it's Aditya Birla Lifestyle, which is going to list today, and therefore it looks interesting. You have a Motilal Oswal note which talks about how the demerged entity now looks in terms of numbers. What they're saying is this entity has a track record, of course, for execution. Revenue has gone from 200 crore in 1999 to around 7,800 crore currently. It runs brands Louis Philippe, Van Heusen, Alan Solly, Peter England, among many others. They also deal with emerging brands, Van Heusen, Innerwear, Reebok, American Eagle. So all of those should drive growth going forward. Stated objectives is 11% CAGR growth, FY24 to FY30. Motilal expects this growth to come in a shade below at around 10%. 700 is the net store addition they are penciling in. Store productivity improvement to likely drive margins, 80 bips on the gross margin front to 59%, 140 bips on the EBITDA margin front to 16.6%. They're valuing this at 16.5 times, 190 being the target price and 171 is the implied demerged price.
Okay. Certainly watch out for that. Thanks a lot for that, Harsh. 3 minutes left for the markets to kickstart trade, and we're not starting off on a very good note. Obviously lower, but 172 odd points. Let's see how this fares off. In line with probably what one would have anticipated. Kush Bora, now is there a trade here on open, or would you wait for some time? Nifty, any stock, anything at all?
So one, I'd wait for a trade. Two, I'd wait for a trade and look for the trade on the long side. I just want to see where this settles, where it deepens, if it deepens further or not. But yes, both the things. I'd want to wait for the first 5, maybe even 15 minutes just to see how things go. Because a lot of strong stocks, that we were seeing are also giving you a softish kind of an opening. So just to see whether this deepens or not. But I would be on the lookout for a trade on the long side.
Okay. Any of the NBFCs, Parag bhai, would you be betting on in this weakness? Because as we've discussed, right, RBI is doing a series of moves. Do NBFCs give you a chance? And if so, what are some of the NBFCs that you would look at? Keep in mind, the HDB Financial's IPO price is much lower, so that's a bit of a dampener.
Yeah. So basically, and as we discussed last time, many NBFCs have moved also.
Yes.
Right? Bajaj Finance has moved. AB Capital, we discussed it 170, now it is 260. So I think most of the move has come also. So I would not be now very, very desperate to buy NBFCs just. And plus, if this geopolitical tension, if oil stabilizes at a higher price, the probability of further rate cuts are very less. As such, RBI stance has moved to neutral from accommodative. So I don't know, some small finance banks like Equitas can be looked at. Of course, we don't have it in the portfolio right now, but they can be looked at.
Okay, let's look at how the pre-open session has settled. You just have about a minute or so to go, and not half bad. About less than 3/4 of a percentage point down on the Nifty. About 172 points down is what we're showing. What's moving early this morning? Look at an Oil India expected with crude impact prices. Look at a Tata investment. Remember, the DRHP has been approved by SEBI for the Tata Capital IPO. You might see some action there. A GE Shipping also buzzing this morning in early trade, as is Bharat Electronics. I would say look out for defense. Any top defense pick very quickly, Kush?
I think in HAL, we've seen a good bit of short covering rally on this one come about on the back of the developments that are happening geopolitically. However, about that 5,000, 5,050, that's a bit of a resistance. But once it crosses that, then 5150, 5200 kind of levels open up. Good accumulation going on at the moment. So HAL, on the radar from a short covering perspective.
Yeah, well, and a couple of positive news flow for HAL as well. We'll talk about that post-market open, but 7 minutes left. Now, one would have thought it is braced for impact, but it doesn't seem like that. Let's see how we start off this Monday morning, a day after the big geopolitical event that happened. 0.6% lower for the Nifty. Banks are a lot more well behaved, by the way. But okay, you could argue marginally in line. Let's pull up Nifty IT and see if there is movement because of Accenture's numbers. No, in fact, 1% lower. Much like how Accenture ended lower, Nifty IT is starting off low too. Parag Thakkar was spot on. Let's get the mid cap and the small cap indices and see what's happening thereof. 0.4% or 0.37%. It's not bad at all. Nifty mid cap is not as low. In fact, small caps are outperforming. This is quite an open this morning we have, ladies and gentlemen. Let's get the heat map up on the screen and show you what's moving and what's not. Maybe a lot more red. Yes, a lot more red and a defensive bent to the winners. So you have a Nestle up 1.47%. ONGC, because of that oil price uptick, naturally. Remember, Oil India, as Tamanna spotted out, is up about 1.5% too. BEL, some order wins. SBI Life, Cipla, a fairly defensive bent to the market, save for maybe an IndusInd Bank. But on the losing side, IT's come off. So clearly, about those order winnings is something that seems to be impacting the mood. Order winnings in Accenture, which were a bit lower maybe. Infi, HCL Tech, Wipro Tech, Mahindra, that entire IT pack is sulking. HUL is lower. Shriram Finance, Dr. Reddy's, Hero MotoCorp bring up the rest. But it's steady at this 0.5% lower mark. Volatility not really massively spiking, just about 3.64% at 14 for the India VIX. Tamanna, not a bad open, pretty much in line with what we anticipated.
Yeah, I would say bearable. It's bearable pain compared to what you would have expected after everything that's happened over the last 48 hours as well. Let's just pull up the broader markets for a second and see what's happening there. And when all else fails, go in for the bonus share. So which is why Nestle is doing well today as well. But less than 0.5% down on mid-cap 150. I mean, you couldn't have asked for better when you think that the Strait of Hormuz may be shut. The small cap 250 pretty much flat. You are seeing a resilient Indian equity market this morning. Even the Nifty less than 0.75% down in the red. Let's pull up the sectoral heat map very quickly for you and see what's moving and what's not. India defense. We told you this morning, watch out for defense stocks when there is winds of war brewing in the region. Defense is expected to do well. Plus, you've had news flow in Hindustan Aeronautics. They're going to make rockets. Bharat Electronics has a new order book. Zentech has new orders coming in as well. Defense is the only green there on the screen. Nifty IT doing very, very badly. I mean, forget Accenture is on one end of the spectrum. But if you have uncertainty in that economy, where are discretionary spends going to come from? How are companies going to want to go out there and put some money on the table? Maybe that's what's bogging down Nifty IT this morning. Consumer durables also middling, but look at that entire range. 0.5% up on the Nifty India Defense and just 1.5% on Nifty IT. So it's quite consolidated. The underlying strength perhaps showing because India VIX also not spiking to that extent. Let's look at specific stocks. Indigo Paints, Berger, Asian Paints. I want to see what the paint stocks are doing because crude trending upwards is not the best idea for paint stocks. Berger Paints is doing all right. Indigo Paints and Asian Paints feeling some of that pain coming in. LT Foods, before we get to LT Foods, let's look at India Oil. Let's look at IOC, HPCL, BPCL, all of those coming in. And as expected, some impact there. Remember the Union Minister saying that we have enough inventory. We don't have to worry too much. India has been shoring in imports from Russia over the last few weeks as well. So we seem like we're on top of that situation. LT Foods, a 340% countervailing duty has been imposed on soybean, something that one of their subsidiaries called EcoPure sells in the United States. 3.5% down on that. Bharat Electronics, because of those new order wins, should be showing some spot of green, about 1.5%. GE Shipping. Trouble brewing, freight rates could go up. GE Shipping also nearly 1% up. Tata Investment is the other one that I want to see. That DRHP was approved. Is there any green over there? Yes, some coming in. So tough to spot winners this morning, but I would say not too hot, not too cold, Neeraj. At least there's no big drawdown in the markets.
Yeah, the spot on, Tamanna, except for maybe IT 1.24% lower, so that's that pickle or the this thing. Just a couple of other stocks that I very quickly want to mark. Remember, PVC prices would be range bound now relative to what was believed earlier to be the case, and I think as a result of which you're seeing stock price movements in Astral, Supreme Industries, etc. So I think that bucket is actually coming lower because BIS implementation in PVC has been pushed to December, and therefore these stocks are correcting in trade, so keep an eye out. And SCI is among stocks which is actually doing well, so keep that in mind. Okay. India Cements, by the way, up 2.5%. So maybe some of the cement names are doing okay. Before I come to come to Parabhay on cement. Very quickly, Kush, opening thoughts, anything that is worth a trade? We are actually now down 0.8% on the Sensex.
So, Neeraj, this is why, the wait and watch approach, when you asked me, because we opened, saw that 50-point bump up, and then we're again back to, those 190, 180 point kind of a downtick. So, not a bad idea to just, weather this out at least for the first half an hour or so, right? I mean, you're not going to miss much. In fact, as Parag had mentioned, if it dips a little further, might just be a buying opportunity at lower prices. What still looks good, first is Nava, the stock that we discussed. Very good volumes on open, already a good price action on this one. Add to that a Home First Finance, again for the last week or so, it's been making good strides. It's just the volatility that's been keeping the upside in check, but on the whole, very good moves on this one. So a couple of names, on the cards. I think what will now happen is 25,000 to 24,800 will become a very narrow range for this week, which also happens to be the monthly expiry for, the indices. So just a little cautious. Still looking for that buying opportunity, particularly on the bank Nifty, but I'm, as I've said before as well, I don't want to be the first one. I'm okay to let go of the first few, points. Once I know a clearer trend has emerged, even for the day, is when I jump in and buy. But yeah, some caution, not a bad idea to begin with.
Okay, Parabhay, very quickly, pockets to look at, and cement features in your list, I reckon.
So cement is my long-term pick. I would like to caution your viewers that it's a long-term pick, because in short term you can say that monsoon, so plus March quarter is always a peak volume for cement. So April, May, June it generally drops off. There might be some people who will say that crude oil going up, so pet coke price will also go up. All these things are there, and there might be people who will say that the prices cannot sustain. But my simple view is that in December we were at a 10-year low in cement prices, and from there the entire industry has started taking some price hikes. Of course, the demand is not very supportive because monsoon has come early, but I am betting on a fact that there is an improved profitability. And see, if for example a company like say India Cement, for example, Ultratech wants to turn it around as fast as possible, right? And after 1st April we have seen price hikes in South, so that will only help them. So India Cement is a good buy. Ultratech, for example, I spoke to them. They have said it on the call that they are going to save 300 rupees per ton over next 2 to 3 years in their cost structure.
Yeah.
They are developing a construction chemical business which is close to 1,000 crore today, becoming 3,000 crore with 35 to 40% ROCE. Plus, this is the only company which is talking about 9 to 10% organic volume growth,
right,
and 15 to 20% including India Cement and Kesoram, that is acquired capacity volume growth. Plus, you will have a 200 rupees per 300 rupees per ton price increases, or I would say EBITDA per ton increase.
Sure.
So this is the only large cap, I would say, in my view, at least within my circle of competence, where I can see 20% EBITDA growth from FY25 to 27.
Okay, all right. So, but that's a long-term view.
Yeah, absolutely long-term view.
So stay, focused on that as well. Although the day is not looking half bad in terms of opportunity, so we should say that as well. Kush, Parag Bhai, thank you so much for joining in on this leg of India Market Open. We're continuing the conversations, and Ajay Srivastav joining in now. He's MD Dimension Corporate Finance Service. Ajay, great to have you on the show.
Good morning.
Why are markets so unbothered? Just look at the last 48 hours. America has struck nuclear installations. We don't know yet whether there is some impact of that or not. Iran is saying they'll shut the Strait of Hormuz. Markets relatively don't seem so worried.
Of course, that happens. Tamanna, that's the beauty of the market, is that the shorts have kind of finished in the market in the last decade. Nobody goes in shorts. In earlier time, you would have seen massive shorts coming into play at this point of time. Short strategy has not paid off. People are ambivalent in terms of immediate result of their portfolios. Very, very ambivalent to say, okay, it doesn't matter, it'll blow up and it'll be an opportunity. But the fact remains that if you enter, important is not that you're holding off, the market is holding off. Important is, are you buying in the market like this, or are you sitting on the sidelines? And shorting, I would say, is a different animal altogether. Leave it aside for a minute. And are you booking profit where you see exuberance? That's a key difference, because the portfolio performance for the next 3 years determines on where you enter the market. You can be absolutely ignorant, put your head in the sand, and as you rightly said, nothing happened to the world, but that's not true. A lot happened to the world in the last 48 hours. And if as investors you don't respond to it, it's your peril. Nothing. Market will do what it's supposed to do. It can remain exuberant, can remain irrational. And you saw what happened in September. When the cuts came, they really came.
Okay, no, I'm going to take that forward. So what you are saying, and from what I'm understanding, correct me if I'm wrong, is that even if you're seeing relative calm in the street, doesn't mean that you shut your eyes and bury your head in the sand. You need to right now look at what's happening with your portfolio and make your own decision. Is that what you're saying? And there is, there are clouds there on the horizon.
Of course, and then not only on the horizon, the cloud is right here in our fine print. The cloud says that the advanced tax growth is 4% at this point of time. Net is 1.6, but let's say gross number is 4%. So you're looking at an economy where the advanced tax payment is 4%. Now, hard to imagine that you will buy stocks assuming a 25% earning growth or 20% earning growth when the advanced tax estimate says it's 4% across the board for the industry. So it's not just the global cloud, it's Indian cloud. Liquidity is huge, humongous in India. And as interest rates go down, people pump more and more into the equity market. Fine. The question is, do you going to get a return out of this investment over a period of 3 to 5 years? Time will tell, but I still believe that where your return gets defined as entry price, this is, I believe, the worst time to perhaps enter the market and start building up portfolios because your domestic is not so good, advanced tax. Global is what it is. Wait it out. April to June quarter has never been good for Indian economy or Indian companies. So, as market can prove anybody wrong or right, but the fact is, merit says, fact says, data says, hold off your investment rather than rush in and build up and put everything into it.
Ajay, good morning. With playing the devil's advocate, wouldn't the quarter one numbers benefit from the base effect of last year?
You may be right, but the fact remains that the absolute change in quarter to quarter is not going to happen. And even if you look at absolute numbers in terms of just the data metrics that you see, whether it is power consumption, whether it is mining, whether it is two-wheeler sales, whether it is PV sales, the absolute numbers are not panning out. And that tells you the story of advanced tax. So, statistics, you can cut it whichever ways you want to say, year to year, quarter to quarter, running quarter, last quarter. But the fact remains that in a calendar year, April to June is the weakest quarter of the year in any case at the end of the day. Very hard for you to get earning surprises in April to June quarter. Other quarters, you can well gather it. In such an environment, market elevated, P's elevated, stock prices crazy, and smart money in cashing. Have you noticed how much sale is taking place? Every P worth its salt wants to get out in cash it's holding. And in the private market, when they talk about it, they just can't believe the bonanza they're getting. There is a company, for instance, which was valued in a PE market at less than 6,000 crores last year, less than a year back, nothing good, and it's got the projection, everything was given. Today is valued at 16,000 crore in the market, and the PE investor is happily selling. Remember this, smart money is selling and booking profit. How much profit you have booked is up to you, but the fact is, money is churning, profit is being booked, institutional money is going out, mutual fund money is coming in place. Let's see where the matrix ends.
Okay, so Ajay, let me ask you, if this is the worst time to build a portfolio, are you sitting on oodles of cash? Have you taken that cash call? Are you invested in other assets? What is it?
See, for everybody, not only for us, of course, now suddenly over a period of time, gold, silver have become big asset. Our big asset is power transmission REITs, which give a very handsome yield, liquid, absolutely. So you never go in cash ever, but you move the allocation around to say, okay, how much is in your precious metals? How much is in the power transmission REITs? How much you keep actual cash on the books? How much is in a dividend yield assets? So I think it's a mix of it. But the idea is that you are right now having money in your bank, at least in various instruments which are giving alternate returns to equity at this point of time. RBI's interest rate policy is over. It has failed because the yields in the government have not gone down. So I'm not sure whether EMI rates are going to go down in the manner that we all envisage, because RBI yields are up, in fact, not down from the day of the credit policy. All in all, the environment is tough out there, my friend, and equity exuberance can last for years. Nobody can argue with that. But the fact is, real economy is real tough at this point of time.
Okay, I'm just wondering, Ajay, and time and again we talk about defense stocks, and the conversation is look at the valuations, and then time and again this happens. Look at India defense today. The fact is that when there is war in the region and we don't know which way it's going to go, every country is going to, shore up its resources. Do you think that defense is still a play that is out there, or it's becoming ridiculous in terms of valuations right now?
Taman, I would say this way, that if you want to play defense today, one would tend to play with the overseas market, particularly the US companies. And there, for instance, I'm not recommending it, but just for information of customers, the ETF of defense and aerospace is up about 30% for the year YTD. Indian defense companies are primarily, the big ones are PSU. So it's a PSU play. Yes, you can play with it. How much they deliver, what happens to them, we don't know the answer. You saw the performance. Maybe one or two companies can be an outlier, Tamanna, because they can do well at this point of time, given the dynamics. But the fact remains that at these valuations and the delivery, okay, and being mostly PSU stocks, private stocks are incredibly stupidly valued. I would use the word that Gavaskar used for one day for the Pant inning called stupid. It's stupidly valued for them to give you 200% return just because in defense. There are about 800 companies producing drones in this country now. So, you can just imagine that drones is a good idea, but 800 companies doing it. So I would say temper the return. Remember this, when at the peak defense mutual funds launched defense schemes, those schemes were underwater for the first 8 to 9 months. One of the schemes is barely above 10 rupee mark at this point of time. As I said, the companies are good, the theme is good. The question is, how well do you walk into the schemes? How well do you walk into the shares, at what prices, and where you make your returns? That's why I advocate that when you buy at these valuations, what are you expecting the company to do at a P of 100 plus? What are you expecting the company to do at this point of time? So one of them may be lucky, but how much of your capital gets allocated to that versus loss maker, you can imagine. If a mutual fund couldn't get it right on defense schemes, you as a portfolio builder should also be careful to say, I will get in, but when the valuation is right. World is not going to fall apart. Company is not going to go away. Things will happen. I have seen this market. You have seen the market. Nikunj has seen market, much smaller than my tenure, but you'll always get opportunities to get in. September was an opportunity to get in. You will get it again. My friend, be patient, relax. It's the month of June. If the children got a holiday, do something about it rather than fretting about a market where we don't know what Mr. Trump will do tomorrow.
What are your holiday plans, Ajay? The reason I'm asking is I was speaking to someone yesterday who wanted to plan a holiday, and they were saying, right now, I don't know which part of the world to go to. Which airline should I take? Should I take Air India? Should I take an American airline? What if, Iran tries to shoot down an American airline from the sky? Should I travel anywhere? What should I do? Which is why I'm asking you, where do you take a holiday? And is this really bad news for that entire sector which has been booming?
Well, it's good news, in fact, for the Indian hospitality industry, because all the traffic which is going to the Middle East and so on and so forth may temper down or travel a little bit. To that extent, I think it'll, on the reverse side, it'll give a bit, fill up to the Indian hospitality, because you say, okay, I forget it. I'm not going to go to the famous places of Baku and et cetera, which have been the flavor of the last 2 years, but I may just, holiday in India. Some of us are a little lucky to have a private places to go to. So, to that extent, that's a luckier part of the segment, thanks to the hard work we've all done. But the fact remains that there are 100 destinations to go to. If you look at Far East, this is a brilliant place to go to. It's cheap, it's economical, it's fantastic, it's hospitable, it's next door, away from all the wars. So there's no shortage of places to go to. I think you just have to switch off the screen and say, we made enough in our life.
Ajay, where are you going? So where are you going?
As I said, some of us are a little lucky to have a private thing. So I think I don't need to travel anywhere, luckily. So I can go switch off and relax in my life. But as I said, it's hard work. We've been lucky because hard work. And hard work means that never get so greedy that you start following the people into a stampede as they jump off the cliffs. Mm-hmm. That's the only reason why I think we are here today. Because we've been prudent about what we get into, not what we get out of it.
Fair enough. Thank you so much.
You're welcome. Have a good day.
Thank you so much, Ajay, for speaking with us. You have a great day as well. I must say that, it's too early to say that all is well, definitely, because we don't know how things are going to pan out in the next couple of days. And oil companies will be in prime focus on the back of this conflict, which has resulted possibly in a threat that the Strait of Hormuz may be closed. So Amit is joining in with more details on what this could mean.
Well, for the oil marketing companies, if you look at, yes, increasing crude oil prices would be negative given the fact that crude is one of the key raw materials for them, and increasing crude oil prices will increase the overall cost of manufacturing that crude and selling, and hence their marketing margins could come under pressure. Hence, oil marketing companies would remain in focus. But apart from that, crude is again a key raw material. The cost of crude makes up for nearly 30 to 35% for paint sector, so paint companies would also remain in focus. Apart from that, aviation. For aviation companies, if you look at ATF is the key raw material or the key cost for them. Nearly 40 to 45% of the total cost is fuel cost, and ATF is the major form of that. And increasing crude oil prices could lead to increase in ATF prices and could impact the margins of the aviation companies. For tire companies, crude derivatives, synthetic rubbers, various other chemicals and carbon blacks, the prices of these raw materials are derived via crude. So increasing crude oil prices could lead to increase in prices of these key raw materials as well and impact their margins. And when it comes to lubricant manufacturers, for lubricant manufacturers, nearly 50% of the raw material cost is crude related, and increase in crude oil prices with a lag impact could increase their raw material cost as well. So broadly, these sectors or these companies remain in focus because of increasing crude oil prices. The raw material cost for these sectors and these companies could increase going forwards. With specific to oil marketing companies, yes, the marketing margins could come under pressure, but on the refining side, the refining margins continue to remain higher at around $6.50 per barrel level, which is way higher compared to what we had seen in the previous quarter. So on the refining side, oil marketing companies are better placed, but on the marketing side, the marketing margins could come off due to rising crude oil prices.
Okay, Sumit, thanks for that. And let's pose that question to somebody who has run HPCL for such a long time and would have a great insight into what oil marketing companies could or could not get impacted, or how will they get impacted. Mr. M.K. Surana, former CMD of HPCL, on the show. Mr. Surana, great having you. Thank you so much for taking the time out and being with us. How do you foresee the to and fro's for oil marketing companies in a scenario as uncertain and volatile as it is right now?
Good morning, and thanks for having me on your show. As far as the crude prices are concerned, we are slightly in an uncertain territory right now. It depends on how Iran reacts to the situation which has developed on Sunday. And the two possibilities we should concern is, one, closure of Strait of Hormuz. Second thing, if Iran retaliates with some action against the other oil-producing assets or storage assets. While generally it is believed that the possibility of both should be lower, in spite of the fact that yesterday Iran Parliament has approved a closure of Hormuz, but subject to their Supreme Leader's assent. But I'm sure that US would have considered this scenario before taking the action which they have taken. Now, in the current scenario, the crude oil, which is running right now at $78 or so, I think, as I mentioned earlier also once on your channel, that till $80, I don't think that there is likely to be any change in the prices. And if it goes above $80 only, there is some thinking maybe there on that issue. And of course, the reduction of the excise duty remains as a tool with the government. As far as oil companies are concerned, if the market prices are not adjusted to the international prices, it will have an hit on their margins, especially the marketing margins. But in past few months, the marketing margins were good, so they will have a little bit of leeway to play with that temporarily, not on a long basis.
Got it, sir. Sir, one question. I mean, the last couple of quarters, it was expected that the marketing margins would inch up higher and that will take care of the profits. But of course, there were inventory losses maybe. And it was believed that now that 2 quarters have passed, the inventory losses would be behind companies. And predominantly, everybody highlighted HPCL. Even today, brokerage notes are talking about HPCL being the key beneficiary as well. My question to you is this. Would 15-20 days of an oil price move above $75 per barrel really hamper the overall profitability for oil marketing companies, or one needs to look at the average for the quarter? I would presume it will be the averages for the quarter.
Actually, the inventory gains or losses depend on day-to-day, actually depending on the way the pricings are determined. So pricing is determined with the rolling average of 15 days on day-to-day basis. But because the marketing pricing are not moving in line with that, so that differential basically adjusts the profit, and that profit may be part of two things, either the inventory gains losses or the operational margins. So as far as the marketing pricing, market price is not being adjusted to the crude prices, it will basically be whether we have got inventory gains or loss. And I won't think that 15 days will make great difference unless there are huge spikes and downs. If it is a gradual thing, if it is a continuously increasing, then you may get the gains. If it is continuously down, you may get a loss. But if it is up and down, it does get adjusted to that extent. And right now, we are in a volatile market to that extent.
Said that, Mr. Surana.
But it will also depend on what the prices you pay on the closing of the period, that is the quarter ending or the year ending.
Okay. Having said that, Mr. Surana, oil marketing companies have had a cushion for quite some time because excise duties have not really been tweaked in line with where crude prices have been going. How long does that cushion last in your view? And at what level will there be a significant change to the pump prices, if at all?
No, we need to also consider that there may be cushion in MS and HSD, but we have got under recovery in the LPG.
Yeah.
So if the overall you see, we need to see the integrated margins of the companies, and there is an accumulated loss on the LPG. So I would think that that cushion is slightly a metaphor, rather, to say to that extent. Unless the whole of the LPG under recovery is recovered, I won't see that cushion exists.
Yeah, the cushion is thinning out if we have to take that metaphor forward. Having said that, just on the petrol and diesel part of it, at what point do you think that the needle moves on pump prices, or we're far away from that portion?
I think we are far away unless there is a substantial change in the ground situation which leads to closure of the Strait of Hormuz, or there is some action which affects or impact the oil marketing oil companies' assets in the surrounding areas. Which both the possibilities I see slightly less likely right now, because there will be an impact on Iran also if the Strait of Hormuz is closed, and also the other regional players who will also try to ensure that the Strait of Hormuz is not closed, and it has not been closed even in the worst of the scenarios earlier. Second thing is because the nearby countries have at least spoken in favor of Iran, I don't think that Iran will try to attack any of those assets in the nearby and create a further negative narration. And the third thing is there is always a possibility of an retaliatory action if the Strait of Hormuz is closed by the people who get affected, including US. So I see that we may see a little bit of uneasy calm for some period in which the oil moving between 75 to 80. Depending on the news, it may go above 80, come down below 80. But the possibility of it crossing three-digit figure is only in case of the Strait of Hormuz is really closed, not said to be closed.
Okay, really closed and said to be closed is the big differential there. Just, your take, Mr. Surana, on India's needs, and just let's pull out from just HPCL right now because you have that amazing perspective. In terms of India's needs, alternates already exist from Russia, etc. How vulnerable are we to all of the geopolitical tension right now?
See, there is a substantial amount of oil and LNG which flows through Strait of Hormuz. So it is not only a question of, because the oil is an international commodity all said and done, and if there is a shortage of oil in the world, the prices will go up. So supply-wise, I don't see that concern because there is a surplus capacity available in the world. And fortunately, India has diversified their sources over a period of time, and while we are still dependent, but less dependent than earlier on the crude which is passing through Strait of Hormuz. But if there is a blockade at Strait of Hormuz, then definitely there will be a sudden spike in the crude price, and that should be worrying to us as well.
Okay. Mr. Surana, one final word. I don't know how much of a liberty you are at to speak about this, but just judging from the capacities that you set up HPCL to build out, right? And now everybody is recognizing that and talking about how earnings for the next 2-3 years could actually be good. I mean, ceteris paribus, oil prices behaving themselves. You reckon from your vantage point that the earnings strength for an HPCL or some of the other oil marketing companies, but HPCL in particular, could be very strong in the next couple of years?
The HPCL has taken actions to increase their capacity, strengthen their product portfolio, and diversify their product portfolio. And many of these projects are coming to fructification. Some have already commissioned, some are going to be commissioned soon. So HPCL definitely have got a trigger point for building up their profitability on that. And if it is coupled with the good refinery margins, I think that HPCL will be beneficiary of it. The second thing is that if the crude price, normally we believe that the base range is 60 to 65, and all the risk premium which are built in to take it above 65, it goes down over a period of time as the tension settles. Then I would believe that all the oil marketing companies should be a beneficiary of that, and HPCL more because of the projects which are coming to fructification now. But that's my personal opinion.
Okay, thank you so much, MP Surana there, former CMD of HPCL, giving his inputs and perspective on what is happening right now. Thank you so much, Mr. Surana, for putting that in place. So, no need to panic as of now. There is some time before you see any impact on pump prices, some time before you see any impact on the books of oil marketing companies as well. It's a threat right now that there will be a closure of the Strait of Hormuz. In fact, we'll pull that up for you in just a couple of minutes. But and you know, there's actually a website which gives you a live map of what's happening in the Strait of Hormuz, and you don't really see any stoppage or, you know, slowdown in traffic over there. So as of this morning, not so much. Although I must say that the Nifty has taken a turn for the worst, near close to its lowest point of the day, as I can see from that chart, over 1% down. 255 points down. Just look at that map, Neeraj. I found that very interesting. All those little very busy bits you're seeing is actually all of the action in the Strait of Hormuz.
Wow.
And so you can see that it's business as usual right now. There will be a whole process before they do that. And what they will do is they will get their warships there. It's a very narrow passage. So first they'll get their warships in, and they will get, you know, those warships to then stop ships passing through. It's fairly simple for them to do, and they've done it temporarily for countries that they don't like. So this is a little more complicated than it's being made out to be. It's not as if, you know, it's a rail track crossing ke aapne patri niche kar di. This is going to be some time before this bears out.
Yeah, but as they say, right, a picture can speak 1,000 words, and that kind of showed it very, very well. So yeah, very interesting. Okay, and you know, while that has been the big talking point, there is a lot of other smaller pieces around markets, right? And let's focus on those for a bit. So before we get the big battery of other guests, market guests coming in. So first, defense companies, they are in focus obviously on back of various order wins as well. Anushi Johnson to tell us about BEL, Zen Technologies and HAL. Anushi, good morning. Why are these in focus today?
Hi, good morning, Neeraj. So BEL in focus on the back of the order win that we are looking at, roughly the size of 585 crore, and they've got orders for fire control and sighting systems for missiles, communication equipment and jammers, along with spares and services. Now, do note that the company had a margin of 29% in FY25, but now they're guiding for a 27% of a margin forward, so that is something we need to keep a track of. 15% is the revenue growth projection as well, and order inflows would be particularly interesting to watch out for. 57,000 crore is the kind of size that we are seeing for inflows for BEL this year. This, of course, includes the big ticket order size of 30,000 crore of QR SAM project as well. Now, HAL, on Friday, we did highlight that it was, as per reports, that it had won a 500 crore of an order win. Now we have that wherein the company has won the bid for manufacturing small satellite launch vehicles developed by ISRO, and this is a new opportunity and foray for HAL forward. Again, this 500 crore was stated earlier in the media reports as well. So, and this is a big update that we are seeing for HAL, is since for ISRO, this is the first of its kind of an order that they have given to a company like HAL. Order book positioning, if you look at for HAL, that stood at 1.84 lakh crore, which was a 95% of an upside considering last year's levels. And final one in focus is Zen Technologies, wherein they've acquired a majority stake in Tissa Aerospace. Now, Tissa Aerospace specializes in Indian development loitering munitions, along with UAVs, that's unmanned aerial vehicles. Now, this is a move to strengthen their presence in the drone market that we are looking at. So, Zentech already has a presence in anti-drone system, but now they want to expand their presence in the drone market as well. So, an interesting update that we are looking at here as well. So, these are the 3 stocks in the defense space in focus.
So defense in focus, Zentech about 2.5% up. Let's pull up Nifty defense, the chart for the day. It's come off some of the highs of the day, even as the market mood is fluctuating at this point. But Paras defense doing well, as are some of the others. HAL and VEL also in focus. What's not doing well is IT. Let's pull up the Nifty IT as well as this component, and you'll see some pain there. Why is that Accenture read-through seen as so negative? 1.5% down on the Nifty IT. Sushovan Nayak joining in. He's research analyst at Anand Rathi Institutional Equities. Sushovan, good morning to you. What did you find, if anything, a little worrisome in the Accenture read-through? Because most of the notes look at it as neutral to positive for Indian IT.
Yeah, hi. This is Shovan here. Hope my voice is audible.
Yes, you are. Please go ahead.
Sure. So basically, one of the reasons why it would have corrected post the results is basically the bookings, right? If you look at the bookings, that is reduced by 6.5%, and within that, the outsourcing bookings have reduced by 10%. The other bit was also your headcount. There has been a decline of almost 1% QOQ. But if you look at it on a YOY basis, that's actually increased. So one of the reasons I believe it would have been construed negatively is because of the US government-related contracts that the management did mention during the con call that there would be almost a 200 bps headwind on account of that. But if we look at it from an Indian IT perspective, I think the BFSI growth, that is almost 13% YOY and 9% quarter on quarter, which is actually very good for the BFSI focused play. Having said that, the discretionary demand environment remains weak, and even in our thematic, we had basically highlighted that Q1 and Q2 may not be that great for an Indian IT perspective, but because the tariff exposures also would result in some weakness. But overall, from a BFSI focused place, those companies should do well, is what our view is.
Okay. So, Shovan, it's been good morning and thank you for joining in. It's been a bit of a what we out here call a tic-tac-toe move for IT services, right? The last 2-3 weeks, up one day, down the next, and it's literally been a pattern of sorts. Is there a breakout from this range anticipated because of business reasons, or a breakdown maybe because of business reasons, or do you reckon RT says range bound for the foreseeable future?
At least the next 1 or 2 quarters, it will be more like one has to be very stock specific, because if you look at the ER&D plays, right, given their exposure to tariffs or whichever companies have got exposure to manufacturing, those are the ones which would get impacted from the next couple of quarters. But if you look at the BFSI focused plays, I think those are the ones which will do really well. And that's basically the thought process.
Would be your pecking order, Sushovan, for Indian IT right now, if you want to build a position, and since it is a bit of a down day?
I would say from the large caps, we really like LTIM and we like Infosys from a large cap standpoint. From the mid caps, we believe that someone like an Emphasis, which has got high BFSI exposure, possibly a Coforge, high BFSI exposure, should continue to do well. Persistent has been doing well. The other bit is Intellect Design is also one of the companies which we like, and Happiest Mind. These are the 2 companies, because Intellect being a 100% BFSI play, the other one, Happiest Minds, there is an M&A transformation play, which is focusing more towards the BFSI and healthcare. Those are the companies which we like as of now, or which will be beneficiaries on account of the BFSI exposure as such.
Okay, thank you for that, Sushovan Nayak there, and quite a long list of stuff that they like coming in. But quick look at where the markets are headed at this point. And Neeraj, I reckon a little bit of a turn for the worse, not massively. You're still under 1% down on the Nifty. some pockets which are showing weakness, and we should pull up the sectoral heat map there for perspective. Definitely IT, what we spoke about right now. The fact is that markets can't make up their mind on what's happening, and these are some of the quotes. Guys, we've spoken to some of the biggest voices to get you a sense of what they are thinking, what the street is thinking. So let me start with what Nilesh Shah has told us. He's told us Indian equity and rates market is like man having average temperature, as one leg is in cold water and the other is in hot water right now. He says domestic factors support current valuation for long-term investors expecting moderate returns. So a bit of a reality check there. Says traders should be extremely cautious. Investors should use correction as an opportunity to accumulate. If you look at it that way, then today is a day to accumulate.
Yeah, and some more voices, by the way. So from the micro to the macro, Manish Dangi, founder of Macro Mosaic Investing and Research, says that we've entered a forever war world. No quick resolution expected in the Iran-Israel conflict. Market impact will be substantial if it hits oil flows and prices. That's the real transmission channel to us in India. Purely from reaction function standpoint, Iran blockading could be likely, and oil is the insider of geopolitics. And if that is the case, then for now, oil is not showing that much of stress, which is maybe a positive.
Meanwhile, here's what Navneet is saying. Navneet Munot says the Iran-Israel conflict is witnessing a significant escalation and may induce further volatility in global markets. For Indian markets, while fundamentals remain strong, there could be a knee-jerk reaction led by global concerns. However, India's robust domestic demand, macroeconomic stability, and ongoing policy momentum provide resilience. Investors should avoid knee-jerk reactions and stay aligned with their long-term goals. Diversification and asset allocation are key. So these are some of the quotes that we have. We have a very short break that we're going into, but on the other side, we get you more news. We tell you why diagnostic stocks are reacting negatively today. We tell you what to do with small finance banks, and of course, that great conversation with Prashant Khemka coming up. All of that on the other side of this break.
Is an ED seeking explanation on Yuvraj Singh, Harbhajan Singh, on why they are endorsing such platforms which are banned by Government of India, and the mule account and Benami transaction, the kind of promotional payout being given to some of the media houses, the ad rates are between 50 crore to 100 crore.
What happens in reality is that under the garb of skill-based game, they end up promoting gambling only.
27,000 crore is what the tax evasion, the top popular betting apps are actually evading. Between January and March alone, they have seen 1.6 billion of traction.
Welcome back. You're watching India Market Open. Joined now by Prashant Khemka, founder of White Oak Capital Group. Prashant, very good morning to you, and thank you so much for speaking with us. Unbothered, largely speaking, is what Indian markets seem to be saying, and the message that they're giving investors. Is there trouble brewing under the surface that we're not really seeing right now? How are you looking at the way markets are responding to all of the action and events in the last couple of days?
Sure, Tamanna. Thanks for having me on the show. So actually, I'm a bit surprised. I would have thought today there would be a bit of a relief rally.
Oh.
Yeah, so we might see a green market. But reality is not that the market was beat up much on worries around the Middle East conflict. So maybe, there wasn't, it wasn't that much of a rally I was thinking, but my gut feel was that it might be green. But obviously the markets are down, as you can see on the screen, by a percentage point or so. The reason I felt it could be a relief is because I think the actions over the weekend, the developments over the weekend, and not going into geopolitics, because I'm certainly not an expert on geopolitics, if at all in any subject, not going into who's right, who's wrong. But I do think this would lead to, it would result in a relative period of calm, or a period of relative calm. There could be some ripples, but there's nothing that suggests to me that it would escalate into a wider conflict. No other countries got involved. Obviously, US got involved, but when US gets involved, that in itself may lead others to stay out of it. Yeah. So that's how I view it. I would have expected, now that there is this risk that people are talking about Strait of Hormuz, but very little that I know about Strait of Hormuz. While it is 20% of global oil transits through there, 80% of that, or more than 80% of it, is the destination is Asia. Largest one being China, then India, South Korea, Japan. None of these countries had a role to play in war. None of these countries, against Iran in any, did not express anything, or there's no history of any animosity with Iran. So yes, I've read that the parliament has approved, if the leader there decides to shut down the Strait of Hormuz, but it's not going to hurt neither Israel nor US. So I just don't know whether it's just a belligerent act of, punishing someone in the world, then it's a different thing. But it is a self-inflicting wound as well. It's like apne pairo pe kulhadi types. They are one of the biggest beneficiaries of oil transport through Strait of Hormuz, and the other beneficiaries are all Asian countries. So why would someone do that? It's hard for me, but as I said, I'm not a expert in geopolitical strategy or anything. But it would seem to me that's not a high probability event. And even if it does materialize, I don't believe it is sustainable for any material period of time, because it inflicts more damage on Iran and other Middle East countries than anybody else.
Prashant, good morning. In some sense, what I'm trying to understand from your opening answer is that this could well mark the beginning of the end of the conflict, at least the one which has been the most recent one, which is involving Israel and Iran per se, right? And therefore, should that be viewed constructively for risk assets, given that the other conflicts still linger on?
I agree. I think you put it well, Neeraj. It could mark beginning of de-escalation or end, because the main area of concern was, for many years, was the potential nuclear capabilities that Iran was building. If indeed those capabilities have been set back, nobody knows for sure. America or Trump has claimed that those, as he put it, obliterated those capabilities and all. If indeed that is true, then that risk is no longer a risk that Israel or America want to eliminate anymore. So Israel and America now, that yes, from our perspective, the job is done, unless they find something contrary to their assumption that those capabilities are obliterated. Yeah, and once, I think if America and Israel pull back, then it should lead to de-escalation of at least conventional warfare. Now there could be, that's why I'm not saying it would lead to peace, but it could lead to relative calm. On the surface, at least, the conventional warfare should calm down, beneath the surface, it could be like there was in Cold War. Always people are building their next step, but that could be very long period. It may not manifest itself in form of conventional warfare. Is my belief, naive belief, you may say.
Prashant, so then, from an investor perspective, it doesn't seem as bad, but no one, I think, is willing at this point to stick their neck out and saying all is well. We are in times where, you wake up.
Tamanna, the moment the market goes up 1%, everyone would say on your channel, all is well. It's just that market is 1% down. That's why people are assuming that market must be seeing something still of concern, and that is why all is not well.
No, Prashant, for a second, let's keep what the markets are doing today aside. Just the fact that, this was something that people didn't expect, that the US will actually go into Iran and bomb 3 nuclear sites and then wait and see what happens. We've not seen what happens next. That's the only part that I'm trying to say. All right, you will keep this aside. We're 1% down. Should have been much more if there was any real concern as of this moment. But having said that, my question is then, is this a wait and watch kind of moment as you are looking at as an astute market reader? Is this a let's go all in while there is still turbulence moment? How are you feeling about the investment horizon in light of what's happening?
So certainly, I think, Tamanna, look, the oil markets, the way they have been behaving, and if you read and hear, obviously Trump is completely unpredictable for himself as well. So we can't say that based on his actions and comments, this was to be expected. But a lot of what he said over the last 2-3 weeks, and he was changing his comments in this direction, initially saying the US has nothing to do with it. And then maybe in 2 weeks' time, he likes to keep that element of surprise. So it was building in the direction that US may get involved in some form or fashion. And they've done this in a clinical manner right now. Be that as it may, what is in the past, I think, yes, we always have to wait and watch how it comes through. All I'm saying is right now, based on what has already happened and what US is claiming that it is done, we are happy. We are satisfied with the outcome. Now, US is no longer the aggressor, and nor would Israel be anymore towards Iran. Now, Iran, whether it retaliates in a very aggressive form, it remains to be seen. And yes, that is a wait and watch. I am willing to, and obviously we are not betting anything in our portfolios basis this. This is just an entertaining, analysis of a geopolitical event. I would say that my bet would be that from here, regardless of commentary and maybe some actions which are, like minor ripples of the main event, but nothing that would perturb the market. And we should see de-escalation, at least from a conventional war perspective in Middle East, especially related to Iran-Israel.
Got it. Okay, Prashant, that's great. And Prashant, with your permission, I would also want to invite Mahesh Nandurkar or Jeffries into this conversation. Just good to get both of you on the same platform and just try and understand how both of you think about it before we let you go, Prashant, because I know you've given us 10-12 minutes, so we won't exceed it beyond. But Mahesh, we were just talking to Prashant, right? And he's saying that he believes that, one, he's surprised by the market reaction today. And in his wisdom, this might well be the beginning of the end of the conflict. And Prashant, I hope I'm not misquoting you here, but Prashant believes that might be constructive for risk assets by and large. Now, what is your sense, Mahesh?
Yeah, hi Neeraj, hi Prashant, hi Tamanna. So I would agree with what Prashant said in terms of the market reaction today. We've been watching the region as well. I think the market movement even from the region is not really that scary. Oil prices are up, but yes, they're up about 2% or so. So again, not scary. So I would tend to go with what Prashant said, that from the reaction that we've seen for today, it looks like not a scary scenario. But whether it's a great news for the market from the medium term to long term perspective. The event itself probably is not turn out to be as scary as we just discussed. But obviously, outside of the event, there are many other things, which is the valuations, the earnings growth, what we're seeing in the corporate earnings and so on. And I think, and more so the corporate equity supply as well. And keeping all those things, in mind, I would say that it's not very easy to take a very bullish view on the markets at this point in time.
Not easy to take a bullish view, perhaps, and I want to come to some of those other factors with Prashant very quickly. Look at the advanced tax numbers that have come out, muted to say the least. Yes, the RBI is trying its best. We've had some push coming in from the RBI, but they did change their stance back from accommodative to neutral. Do you think that from an Indian perspective, maybe there are not bigger fish to fry, but other problems that we need to tackle as well before we head into Q2 and get more cues from there on corporate earnings?
Yeah, Sudhamana, these are all part and parcel of what I call conventional macro. And I think historically they've not really moved much the market. These are how many times, Tamanna, you see over the last 2, 3, 5 years, you would have muted numbers from advanced tax or from GST collections. Sometimes they're strong, sometimes they're weak. These are just day to day. Even if they move the market, they might move by some basis points, 5, 10 basis points, which would not be evident from watching the market because there's just normal volatility there. So I think they're all part and parcel of normal life. And we don't really follow these so much, so I don't have a very or any view on the impact of these. I think earnings growth through all this should, because you have like dozens and dozens of these factors, right? The monsoon is good, something else is poor, and so on and so forth. So I think low double-digit earnings growth for the coming year is reasonable expectation, and that's good enough for market where it is currently valued at the average of last 10 years, 10, 11, like from 2014 till now, last 11 year average is about 20, 21 times, which is where the market is today on forward 12 months number. So it's a normal valuation for a average kind of earnings growth over expected, not just over the next 12 months, but I would say looking forward for years to come.
Mahesh, just want to get your sense about the kind of appetite that you expect to see going forward, looking at what's happening in promoter stake sales, what's happening in the private equity space, in the IPO space. Do you see that cash squeeze continue? And what are you reading in the tea leaves when you see so many promoters coming in to maybe cash out?
Yeah, so the equity paper supply, in my view, is a reasonably large factor for all of us to keep in mind. I would say that the second half of last calendar year, which is between July to December last year, we saw a pretty big jump in the equity paper supply, and our calculations suggest that it was upwards of $7 billion a month. And this time around, we obviously started the year on a quiet note because the market itself was not really doing that well. But in the month of May, we saw about $7 billion of money being raised. June is moving towards that direction. And from what I understand, if the market stays where it is, then probably this type of supply will be continuing going forward as well over the next several months, and which I think in turn will probably cap the market return. So that's, is one of the reasons why I feel that the markets may not really move dramatically upwards from here on. The demand side for equity, which is the flows that we talk about, the domestic flows, the foreign flows, I think those are on the positive side. Although the domestic flows, understandably so, have come down somewhat, but still in the net positive zone as we speak. The foreign flows have turned positive over the last 2-3 months, and I would say that my interactions with global investors suggest that there is an incremental interest, coming towards I would say broadly the non-US markets like the European eventually should flow into emerging markets as well. And India is obviously one of the more prominent of all of those. So that's been on the positive side. So that I think story is well flagged, but I think this equity supply is something that we need to keep in mind. I would broadly say that it's not such a bad thing for the equity supply to have increased, because I think this will also help keep the market valuations under check, in my view.
Okay, Prashant, before we let you go, and it's an interesting point that, of course, Mahesh has spoken about as well. Two factors to this, because you are also an investor into global markets, which are competing with India. And at the same time, you're a recipient of flows from your investors who might want this India exposure in a meaningful way, right? How do you see this playing out? When you are looking at a GEM fund, are you increasing or decreasing the allocation to India? And what do you hear from your clients, Prashant, about the feel to invest into India or non-US assets, as a lot of people, including Jeffrey Gundlach, has said that, put money into India and don't look at the tape for the next 30 years and you will benefit, etc. How do you think about it as an investor?
Certainly. So see, in our EM fund, we are usually, and our clients also, expect, or we've set that expectation with our clients also, to expect India to be almost always be a higher allocation than the benchmark. So over allocated to India. It's not necessarily a top-down bullish view that India would outperform the rest of the world or anything. It's just that the bottom-up alpha opportunities, the opportunity to outperform the market, we find more compelling numbers in India, larger number of such opportunities in India, and also where our capabilities are the strongest. We have a home ground advantage in India as well. So it is overweight, but for different reasons, not necessarily because we believe India would outperform. We, consistent with what Mahesh was saying, I would say that we expect India to deliver moderate or average returns, which it has delivered historically, which is low double-digit returns in rupee terms, high single-digit in dollar terms, which is not expected to be too different from what other emerging market countries may provide at an index level. But at a stock selection or at a portfolio level, we expect the alpha or outperformance in India to be stronger given the capabilities we have and given the nature of the Indian market.
Prashant, thank you so much for your time and extension of your time here. And we really enjoyed that conversation with you and Mahesh, but we'll let you go.
Always a pleasure, Tamanna and Neeraj, and good to see you, Mahesh.
All right, so Prashant Khemka there. We'll continue the conversation with Mahesh Nandurkar, of course. And Mahesh, I just want to pick up from what you said last, where you said that the interest from foreign investors is beginning to shore up when it comes to India. Where is that interest going? Because your typical sort of destinations, your BFSI, is not showing that kind of spark. Do you think that the underlying worries there? What are you liking right now when you see, the markets from an India perspective?
Yeah, so you're right. So typically, the large FPI flows, when we see the tides turning, it usually goes in favor of BFSI segment, as you rightly mentioned. But I think, this time around, I think the key point to note here is that despite the fact that we've seen such a large rate cuts by the RBI, and the fact that it is likely to have a negative near-term impact on the bank's EPS because of the net interest margins going down, the banking sector has actually performed in line with the market, actually slightly better than the market. So in fact, I would say that the large banks that did underperform for a period of time, year to date in this current calendar, they've actually done reasonably well. And we were expecting it to be that way. And I'm glad that it has turned out to be that way. So I would say that from the foreign investors' point of view, banks and also I would say NBFCs would continue to be one of the areas that would look interesting to them. Also from the valuation standpoint, while one would argue that the current MSCI sort of index trading at about, let's say, 22 times 1 year forward earnings is about one standard deviation higher than the last 10-year average, but the average at the index level have been held down because of the banks. If you actually take the BFSI segment or the banking sector out, the 1 year forward earnings multiple for the market as a whole would jump up to 26 times, which is quite steep. So it's the valuation comfort and also the fact that the RBI has turned significantly pro-growth as compared to the stance that it had most part of last calendar year is also a big positive for the lenders, for the BFSI segment as a whole. So that does remain one of our most attractive sectoral bets.
Got it. And yeah, I mean, with the new Reserve Bank of India, it seems to be a different landscape altogether. Mahesh, the other factor is whether this whole geopolitical piece that continues now in such a wide fashion, despite the hopeful de-escalation, at least with Iran and Israel, does it make the richly valued defense stocks still stay center stage in the minds of investors and firms like yours, which are writing notes on these companies? Do they occupy mind space?
They do, and I think it would continue it would continue to be that way in my view, because increasingly what we are seeing is that there are more and more such instances that we are seeing over the last 2-3 years. And as far as India's defense expenditure goes, I would say that the defense capex as a percentage of GDP today is at about 50 basis points. Over the last 20 years, if you see, it has ranged between 50 basis points to 1 percentage point of GDP. And given all the geopolitical tensions all around the world, also in the subcontinent, I think even for India, it needs to be towards the higher end of the historical range and not the lower end. So my sense is that over the next 5 years or so, I would expect India's defense capex to be rising by 25% CAGR. And plus on top of that, there are other things like Make in India, and there are some small examples of Indian armaments being exported as well, etc. So there is a pretty strong growth outlook for many of the companies that are involved in this defense space. And I hear what you said completely, that the valuations are rich and it's going to take some time for the order book to grow and etc. But I think from a thematic perspective, it still makes sense to be positioned in that space.
So we have talked about BFSI, you're constructive, defense, you're constructive. How are you feeling about IT, Mahesh?
IT, we are not feeling that constructive. So it's a sector that we have been, underweight on. And I think, given where the stocks have moved up very quickly in the last, 1 month or so towards the higher end. In fact, almost like 1 standard deviation higher than their historical averages. And clearly, the economic outlook in the US is not really very conducive in terms of the discretionary capex for the large US corporations to be rising at this point in time. In fact, one of the large companies that just reported results over the weekend, the numbers were actually, not that great, and they've ended up cutting the guidance as well. So my sense is that given the combination of pretty richly valued, PE multiples, and combined with that, the fact that the outlook from the US corporations increasing their discretionary capex doesn't look that great, we would be underweight on IT services.
Just on Accenture, Mahesh, a follow-up there, because, the way Accenture read from brokerages as well this morning as well, it didn't seem half as bad. Which is why just a little bit more of elaboration there from you. Growth guidance 6 to 7%. What, if you had to narrow down or pinpoint, what is the concern or the red sign or the red flag that you're seeing there, which is of course a spillover for Indian IT?
Yeah, I unfortunately cannot talk about individual stocks here, but what I would broadly speaking say is that the fact that the growth guidance was brought down. And as I mentioned earlier, what we really need for the Indian IT services companies to kind of outperform going forward is the confidence that the discretionary capex from the USA is going to be rising, and we are not getting that comfort at this point in time.
Okay, Mahesh, one one final word, and which is that what's the dark horse here? I mean, in a market which you don't anticipate to go so high, and some of the usual suspects like BFSI and defense being top of the mind, if you will, is there a dark horse, something that you guys might be a minority on, either on the bullish side or on the bearish side?
Yeah, so on the bullish side, I would say apart from these two, the other sectors that we like are telecom, I would say cement, and also two-wheelers. So those are the other three sectors that we like. Now, one might say that telecom is not really a dark horse because it's a sector that has already done quite well. So yeah, maybe not. I would also highlight cement, as a sector here, because I feel that the pricing environment in cement has turned around, and I think cement pricing is really the key for the stocks to perform. And my sense is that after remaining subdued for a very long period of time, for nearly last 10 years now, in my view, the cement pricing is showing some initial signs of moving up. So I would say that can be, a pretty strong dark horse going forward. And one of the factors that I wanted to sort of support that thesis with is also the fact that if you look at, and it's a slightly different angle, a differentiated angle, which is, on the GST side. So we all know that when GST was implemented, back in 2017, there was, a 5-year window that was given for the state governments in the form of GST cess collected on some of the categories and distributed to the states as a way of compensation. And that was supposed to get over by 2022. But then afterwards, because of the COVID that came in between, there was a shortfall, and then that compensation period was extended, through to like March 26. So it's basically this current financial year, FY26, is the last financial year, wherein that compensation will be paid, and which basically means that, almost a $20 billion annual GST cess collection will be surplus from next year onwards. And government has a lot of options to use that $20 billion. I mean, one is obviously upping the defense sort of capex, bringing down the fiscal deficit, and variety of other things. But specifically in case of GST, also I see a strong case for the GST on some categories where it's sitting at a very high level of 28% can be viewed. And I would say two-wheelers and cement are the two sectors where there's a possibility of that being sort of viewed. So that's an additional point, for cement. But as I said, the basic thesis that we have is the pricing environment has started to improve.
All right. Thank you so much, Mahesh. Always a pleasure to chat with you. Mahesh Nandurkar of Jefferies there with, that clarity and view. I think the big headline coming out from there is also that foreign investors have started showing more and more interest in Indian markets, and that really is beginning to be seen. All right, one stock which is in focus this morning, before we wrap the show, we want to talk about it very quickly, Z Entertainment. Now, over the weekend, they put out their investor presentation. In fact, yesterday, there's a reason that stock is 8% up. They are hoping to achieve break-even in Z5 in FY25 itself, or FY26, is it? Hiral, give us more details.
Thank you, Tamanna, for that. So that's an interesting point that they've made, that they will achieve, they're planning to achieve a break-even in Z5, with regards to an EBITDA loss that was posted of around 548 crores on FY25. And they're talking about FY26. They're looking at maximization of risk-free treasury income as well. So that is going to be an addition, other income benefit that the company is looking to get. Very quickly, what they've indicated is a significant cash reserve is what they are aiming at. And this is mainly to compete with competition effectively, for which they've actually gone ahead and enhanced their digital offerings as well in a profitable manner. And this is in the domestic and the international market without going beyond the content ecosystem. They're developing new business verticals as well to expand its target audience and augment the revenue streams. And they're looking at a new distribution business model as well, so that they capture a larger, portion in terms of eyeballs. They're enhancing their content offering from long format to short format. And because of this, if you see the stock price run up in the last one month as well, it's pretty much on an upward trajectory. They will look at expansion in the inorganic format through acquisitions or strategic partnerships, and this will mainly be done in high growth verticals such as digital music. And they've said that they will maintain a healthy balance sheet and closely monitor any medium term capital requirements. They have proposed a preferential issue as well, and this is through fully convertible warrants of around 2,240 odd crores. The conversion price per warrant is around 132, wherein the floor price is around 128. So it's 25% of the upfront consideration, whereas the balance 75% will be within 18 months, and the conversion will happen into equity post the receipt of 100% consideration, for which they are looking at a shareholder approval at a meeting that will be held on the 10th of July. And post this conversion, the promoter stake then will be around 18.39%. Very lastly, in terms of growth initiatives, they've said all of it will be core to the business and scalable and value accretive from here on. The capital that will be deployed with regards to where the growth initiatives are concerned will be mainly aimed at enhancing profitability of the company in the next 3 years, and it will surpass the highest earnings per share that was delivered by the company, and this was at a capital base of around 16.5. This was back then in FY19. So the plans are looking absolutely strong with regards to the commentary that they've put out in the investor presentation. Execution is going to be key from here on, and the meeting on the 10th of July with regards to the warrants is going to be interesting to watch out for.
Okay, so all right, Z, and frankly, media is doing well as well. Saregama also up this morning. So some bright spots there. We're leaving the show with markets, I would say, consolidating but range bound, less than about 1% down, which all things considered is not half bad, Neeraj, just we wrap up India market open.
Yeah, summed it up well. So nothing more to add to that. Consolidating, range bound, 1% lower, an outcome much better than what people would have anticipated. But if you have specific queries, stay on. It's a wrap on India market open, of course, but Ask Profit comes up next. So stay tuned to NDTV Profit.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Sources in ED seeking explanation on Yuvraj Singh, Harbhajan Singh, on why they are endorsing such platforms which are banned by Government of India, and the mule account and Benami transaction, the kind of promotional payout being given to some of the media houses, the ad rates are between 50 crore to 100 crore.
What happens in reality is that under the garb of skill-based game, they end up promoting gambling only.
27,000 crore is what the tax evasion, the top popular betting apps are actually evading. Between January and March alone, they have seen 1.6 billion of traction.
Imports become the exception rather than the norm, and increasingly we do almost last year, for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
what Defense Secretary Sir said is 100% true. And today private industry can really increase their involvement in R&D.
I am very proud to say that we make, in our categories that we have been supplying to our defense forces, some of the best platforms in the world.
The markets move fast.
And so
Hi, thanks so much for joining in. Happy Monday to you. My name is Alex Matthew. With me is Mahima Vachrajani, and this is Ask Profit. I know a lot of you woke up this morning getting ready to buy the dip, but Mahima, where's the dip?
Exactly. Like we were joking about yesterday also, we were talking to a lot of market analysts, and in fact they said that the markets are mature enough to take this, and we might not see a significant amount of downtick, but yes, there's no dip as such to buy the dip.
Absolutely.
For sure.
So let's talk about what's happening, right? So, and ultimately from India's perspective, the big focus has been crude oil prices, and Brent crude has remained pretty much where it was over the course of the weekend, or actually last week, and it's hovering around that $77 per barrel mark. And why this is that while there is a threat to close the Strait of Hormuz, which is, as you know, a major maritime route that allows the transfer of both crude oil as well as natural gas, that hasn't happened yet. And as a result of which crude oil prices are where they were. Of course, there is a risk premium, that is because of this increased geopolitical tension. The analysts are saying that as much as $10 is added to the cost of crude, but it's not very bad at this point. It's not, as some people were projecting, rising as much as $100 per barrel. And that's good news for India. So you have the benchmark that is trading with cuts of about 0.9%. And this, when compared with what happened on Friday, where the equity markets rallied in a broad-based rally, and you had the Nifty 50 that went above 25,000, well, this is par for the course. You expect that there would be some unwinding of what happened on Friday. But the broader markets are looking better. In fact, the mid-cap index is down just about 0.1% or 0.2% or so, and the small-cap index is trading in the green. I also want to take a look at the market breadth to see how it's changed over the course of the morning so far. I wouldn't be surprised if the gap is narrowed, and that indeed has taken place. So there you see, at the start of trade, you had a pretty wide gap between the advances and declines. The green there is the advances, and that has closed quite a bit. So you could see that panning out over the course of the session as well. I'll very quickly point out one sector that is in focus, or rather two. One is IT. IT is the big laggard in trade today, down about 1.6%, and that's because the Accenture numbers flattered to deceive, you can call it that. And so quite a few of the large cap names are losing ground. Infosys is one of them, which is the biggest loser on the Nifty 50 and down about 2.5% or so. But defense on the other end of the spectrum is doing particularly well for obvious reasons, because geopolitics is once again at the forefront and is gaining about 1.4%.
Right, and some other counters that are doing well, Z Limited especially, because the entertainment, because of the presentation where they've mentioned that Z5 will achieve break-even in FY26, and the stock is soaring on the back of that, up almost 9% as we speak. LT Foods under pressure because its US subsidiary received a countervailing duty of more than 340%. BL, HAL on the back of order wins, Zentech as well on the back of order wins. Of course, the geopolitical reason as well. There's Lloyd's Metal, which is also buzzing in trade on commissioning of two of its plants. There's Aventil again on the back of an order win. The stock is up. NLC India also on the back of an LOA is up and doing well in trade today. But these are some stock specific names of course. With that, let's also welcome in our guest for the day, Nilesh Jain, Centrum Broking, from Centrum Broking, and Saurabh Jain of SMC Global Securities joining us now. Before I take stock specific questions, Nilesh, your quick view on how you're expecting markets to pan out this week.
Very good morning to you. Good morning, everyone. So this week, since we have monthly FN expiry for the Nifty and Bank Nifty, we are expecting a bit of volatility. Today, we have seen a gap down opening and markets are not able to hold on to its gain that we saw on Friday. And today is more sort of a consolidation we are witnessing. Good part is that Nifty is still trading well above its 21-day moving average that is placed at 24,860. So that is likely to act immediate support from intraday point of view, followed by 24,500. That's the strike where we have seen huge amount of put writing. So from this week's point of view, I think the broader range for the Nifty could be 24,500, 25,200, and narrow range could be somewhere around 24,700. Nifty should find some bit of support and we may see rebound from here. And on the upside, a breakout about 25,000 will open further upside of 25,200 as well. So overall, we are expecting a bit of volatility where stocks and sector specific moves should continue. And the volatility index today spiked up close to 3%. It is currently at 14.11. So overall, it is very much in the comfort zone as of now. But any rise from here would be a cause of concern. So watch out for important levels as highlighted. We are expecting sectors and sectorial and stock specific move to continue.
All right. So, by the way, we started the show. I assume that a lot of you know this, but in case you don't, you can call us on the number that is on the bottom of your screen, or you can send us a message on the number that is on the top of your screen, as quite a few of you have already done. So, without further ado, let me go across to the first question. And Kailash Patil is writing in from Pune and asking about NMDC, which he's bought at levels of 40 rupees. He's considering adding more at the current price. Is this the ideal time to accumulate further? And is this a good idea to hold as a portfolio stock? He's identified that he wants to hold this for at least 10 years, which is quite a long period of time. Saurav, very good morning to you. What would you say about NMDC?
Good morning, Alex. See, for the 10-year perspective, I think it is a kind of a value stock, and the valuation side it is quite comforting. Since he has got a very long horizon, I think it makes sense to add on declines.
Could you tell me a little bit more about why you're saying this is a good value stock, earnings-wise as well?
Earning-wise, I mean, there is a bit of cyclicality in the metals. So, being a ore producer, we expect things to improve gradually going next year. And when things will improve, prices will also increase, and it will give margin expansion and higher profitability to the company. So, in that sense, I am saying it is a value stock.
So that's with regards to where NMDC stands. Our next question is from Pakshal Jain, who's writing in from Bellary. He's holding Manappuram Finance 160 shares bought at 177 a piece and wants to know if he can hold or book profits. He wants a view for the next 2 odd years. Saurabh, I'll come to you on this one. Manappuram Finance, what's the outlook like?
While the business outlook is good, there are quite a bit of guidelines which has come for the gold loan companies. But in my opinion, I think when you're betting on a gold loan company, I think Muthoot Finance is a better choice than Manappuram.
Okay. All right. So that's a pick in the gold financing space. We've got our first caller of the day. Pradeep is calling us from Bengaluru. Pradeep, very good morning to you. How can we help you today?
Good morning to everybody there. See, I am a long-term investor, small-time long-term investor with a vision of another 2 to 3 years. Now, I had bought Pidilite Industries about 3.5 years back at 2,324 rupees. Now, this stock has not delivered significant returns in this period. So I just wanted to know whether I should hold on to it or whether I should book profits. And if I book profits, whether Shriram Finance is a good choice.
Okay. So, okay. All right. So, 2,324 was your buy price. You've held it for a little while. I think it's been a decent run. Of course, Pidilite is a very large company and large stock. So, therefore, the gains that you've had over that period are nothing to sneeze at. But the question is valid. So, let me go across to Saurabh. Saurabh, gains to the extent of it's now 2,941. So, he's made a pretty penny. Would you find a better outlet in the finance space? And a lot of people are pivoting in anticipation of an improvement in lending rates, etc.
Yeah, I mean, finance is anyway a good option. In fact, the choice he has made is also a good pick. But in my opinion, I think betting on a large cap bank like Axis or ICICI may also be a good choice.
So that's with regards to where these counters are concerned. Our next question is on Suman Capital. Okay, no, it's on Castrol India, and the person is a long-term investor. Ratish Menon is writing in, by the way, and he's a long-term investor, and he's holding 240 shares of Castrol India, bought at 204 a piece. Wants to know if he can average or exit at the moment. Saurabh, I'll again stick with you for this one for a specific reason, because Castrol India is that counter that uses oil as derivatives, and if crude intends to spike up further on the back of the entire Iran-Israel conflict, what is the kind of outlook for the company that you're watching out for, because that's a key raw material for them?
If you look at the automobile space, there has not been much growth. It's been basically all the OEMs are reporting, very negative or maybe a smaller growth rates. In case of Castrol India, it is not that its raw material is directly linked to crude oil prices, but it is related to base oil prices. Normally, company tries to maintain their margin in adverse conditions also. Yes, it is a good stock to hold for the long term. But in short term, I think there would not be any price movement with respect to the broader markets.
Okay, all right. So some of you are asking, in fact, Lalita, who's just messaged, is asking, I'm not sure my messages are being noticed. They are being noticed. It's just that Mahima and I can't respond to all of them. And by the way, this is addressed to you, Mahima, but I will take it if that's not a problem. Reddington is the name of the company that Lalita wants to know about. She's bought at levels of 45 rupees. She's asking whether it can be added at this price. Wow, 45 rupees, is that right? Can we pull up the very long-term charts and see when it hit that level? Okay, so I can't see 45 rupees on that chart as well. I'm wondering, yeah, at least 5 years. So she's been holding for a while. She's wondering whether it can be held for another 1 year. Can more be added? So Nilesh, I'll come to you on the charts. What are the prospects?
So Alex, this stock has given a good multi-bagger kind of return, and looking at the overall structure, still it has a potential to move towards 350 to 400 from a short to medium term perspective. Maybe in next 1 year, we may see the stock moving towards 350 to 400 zone. So overall, it's a buy and decline structure, but not advisable to buy at the high levels because the risk and reward is not favorable. It's better to wait for some bit of decline towards 260, 270. That can be a good entry point in terms of averaging as well. That can be done. For any long position, one should keep a trailing stop loss at 250. So that's a good support. If it breaks below 250, then chances are very high that we may see further selling pressure to continue. But as of now, it's good bet to be, stay put, and positionally 350 to 400 is the target.
With regards to where charts are concerned for Reddington, our next question, in fact, our next caller, Raghuveer, is calling in from Bengaluru. Raghuveer, a very good morning to you. कैसे मदद करें आपकी?
Good morning. मेरा पास 2400 शेयर है वकार फार्मा का, 280 रुपए में लिया हूँ।
ठीक है।
उसके पहले 750 शेयर बेच चुका हूँ 1450 में।
ओके।
अभी एक साल रख सकता हूँ। अभी मैं ऊपर का टारगेट क्या रेट है?
ठीक है, मैं समझ गई आपका क्वेश्चन। सौरभ, आई टेक दिस अप विथ यू, एंड इफ पॉसिबल आप हिंदी में आंसर कर सकते हैं तो वॉक हार्ड इज द काउंटर दैट ही इज होल्डिंग। 1 year इज हिज टाइम पीरियड, व्हाट डू यू थिंक ही शुड डू?
देखिए, कंपनी ने पिछले कुछ सालों में काफी टर्न अराउंड किया, इन्हें इसी बात का काफी फायदा भी मिला। फार्मास्यूटिकल में एक अच्छी जानी मानी कंपनी मुझे लगती है। कुछ शेयर ये पहले ही 1450 रुपए में, जैसे इन्होंने बताया, बुक कर चुके हैं। मैं समझता हूँ कि कुछ शेयर इन्हें यहाँ पर भी जरूर बुक कर सकते हैं, और क्योंकि इनका 1 साल का नजरिया है, इससे ज्यादा ये नहीं रखना चाहते, तो मैं समझता हूँ कुछ अनिश्चितताएं हैं अभी भी बाजारों में। यूएस की तरफ से कुछ भी ऐसा आ सकता है जो इंडियन फार्मास्यूटिकल कंपनी के लिए नेगेटिव हो सकता है। तो मेरी सलाह रहेगी यहाँ पर भी और थोड़ा प्रॉफिट बुक करें और बाकी को होल्ड करें।
इफ यू आर स्टिल देयर, मेरे को सिर्फ एक बात समझनी थी, क्योंकि आपने बहुत अट्रैक्टिव प्राइस पे बाय किया है और ऑलमोस्ट 34 लाख प्लस के प्रॉफिट पे हैं आप। क्या सोच के बाय किया था वॉकहार्ड?
हेलो नहीं, हमें पहले 3-4 साल को पहले बाय किया था।
हाँ।
हमने पहले 800 में किया, उसमें 600 में किया, उसमें 500 में किया, उसमें 200 में किया, उसके बाद लास्ट में 165 में 2000 बाय किया, तो टोटल 3000 बाय किया था मैं।
अच्छा।
उसके बाद 750, 1450 में भेजा, परसों 200 शेयर भेजा हूँ, 2770 में भेजा हूँ।
अच्छा, नहीं मैं पूछ रही हूँ कि जब आपने बाय किया तो क्या सोच के बाय किया ये?
हमने पहले 10 साल के पहले एक बार किया, तो उसमें मेरे को प्रॉफिट आया था, ऐसे ही प्रॉफिट आया था। 200 में पैसा 800 में सेल किया था, वही 800 आया था।
अच्छा।
इसलिए हमें 800 में ऊपर के करके एवरेज करके ऐसा रखा हूँ। अभी मेरा टारगेट है 2000 आ सकता है या नहीं आता, वही पूछ रहा हूँ मैं।
अच्छा ठीक है, ओके 2000 आ सकता है कि नहीं? तो सौरभ का ये कहना है कि थोड़ा सा प्रॉफिट बुकिंग कर लो और थोड़ा सा रखो
करने की शुरू किया हूँ।
ओके।
मैं पिछले बार में 1750 में 200 शेयर बेच चुका हूँ। अभी हमें आज भी डाला हूँ 1900 में डाला हूँ 500 शेयर।
ठीक है, ओके, समझ गए रघुवीर। ठीक है, थैंक यू सो मच फॉर कॉलिंग एंड कांग्रेचुलेशंस ऑन द प्रॉफिट्स दैट यू आर मेकिंग. All right, our next question then is from Jai Krishnan, who's writing in from Kerala and wants to know if this is the right time to make an entry in Technoplast from a medium term time Technoplast from a medium term perspective. You know, Saurabh, I'll come to you on this one. Is time Technoplast the right counter to make an entry into right now?
It's a very good and old company. If you look at the operational front, the business is making good progress. The company is putting up, double-digit growth year on year. In my sense, I think it is a good stock to invest.
If I remember correctly, the Q4 numbers for Time Technoplast were particularly good. And as a result of which the stock did rise quite dramatically over the course of the last 1 month. There you see about 20% or so. All right, Dheeraj is our next caller calling us from Hyderabad. Very good morning, Dheeraj. How can we help you today?
Sir, good morning. Actually, thanks for the show. I should be very grateful to all of you guys, everyone.
It's our pleasure.
So, sir, my query is regarding Adani Green, sir.
Okay.
Sir, I have purchased 650 shares of Adani Green at 947 rupees. Sir, actually I have booked losses in Geo Finance and Premier Energies of rupees 20,000.
Right.
And I have purchased these shares.
Yeah.
Because recently the stock reached a level of around 1080. In January, it reached, if we see the 1 year chart, the all-time high is around 2080 rupees.
Yes.
So, recently in January, it reached the level of 1080.
Yes.
So, I have seen strong support at 900 and 920 rupees. And Adani Green is a huge stock as in the renewable space and power space.
Yeah.
The entire power space is underperforming as of now.
Yeah.
And the entire renewable space is underperforming.
Yeah.
So, if the index reaches the next level or the next week, I would like to hold it for the next 1 year actually.
Okay. So you're looking at what levels you can get. I got your question, Dheeraj, and very well analyzed. But let me get you a view on the technicals, if that is okay. Nilesh, I'm coming to you on this. 947 is the price that he's bought at, and he's looking at a 1 year potential. Of course, it's pretty far away from all-time highs. What is the upside potential that you see?
Well, Lex, this particular stock has been one of the underperformer, and recently, as he rightly pointed out, that the stock has taken a good support at 920, 930 zone. So that is still acting as a very strong support zone. With a stop loss below the same, long position can be held, and we can expect a gradual recovery towards 1050 to 1100 from a short-term perspective. And from a position perspective, a breakout is awaited. It should break the level of 1080. If that happens, then we can expect a strong movement today towards the levels of 1200 to 1300 as well. But do not expect this stock to correlate with the market, because the stock has been one of the underperformer within this space as well. So keeping a stop loss near 920, the long position can be held, and we can expect a gradual recovery. But I'm not expecting any V-shaped kind of recovery in this particular stock.
Keep an eye on the fundamentals as well. There's a lot, Dheeraj, as you know, as you probably read, that is happening with renewable energy and what Adani Green specifically is doing. So I'd encourage you to have a look at that. But the standard disclaimer here, Adani Green is part of the Adani Group, and so is NDTV Group, of which NDTV Profit is a part. The next question is from Anurag, who's writing in from New Delhi and asking about Amara Raja Energy and Mobility. He's bought 28 shares at an average price of 1,168 rupees per share, and he's losing a little bit of ground. He's got a perspective for the next 1.5 to 2 years, and he's wondering what he should do with this. Sort of on the fundamentals, is this the best play in your opinion in this space?
Well, it is a very good and old company in the battery space. They are doing a lot of research activity also on the lithium side. Also, they have a small business in the. They have small exposure towards mobile oil business also. But I don't know why this stock is consistently underperforming. If you look at the valuations, it is on the lower side. I think it is better. I think you should wait for this quarter, get the sense how this quarter pans out and what the management give guidance for the ensuing quarters. Then take a call.
All right, so that's the view. Hold is the view on Amara Raja batteries. Our next caller, Vinod, is calling in from Karnataka. Vinod, a very good morning to you. How can we help you today?
I have brought the Varun Beverages shares of 512 rupees at 120 number of shares, ma'am.
Okay.
The share which is in negative trends still from past 6 months. I don't know what is the reason for the negative sentiment of the share, despite of doing good revenue and good profit from the last quarters and past year.
Right. And you want to continue to hold this from a longer term perspective, right, Vinod?
Yes, ma'am.
Okay, I'll take this up with Saurabh then. Saurabh, what he's talking about is that since the past 6 months, the stock has not done well. And this is because the stock had seen a significant run up before that. Plus, valuations have never gotten cheaper for something like a Varun Beverages, right? What's your sense like? Should he continue to hold this counter from a longer term perspective?
You're absolutely right. The stock has seen phenomenal rise and the valuations were always expensive. I think it is normally these 6 months are good period for this company. And after so much expansion plans, I expect the numbers to be good for the June quarter and in fact also for the September quarter. My sense is it is better to hold.
To hold. Okay, Varun Beverages. Hope that answers your question, Vinod. The next question is from Sudhir Agarwal, who is asking about ACC. He's got 1,000 shares, which he's bought at levels of 1,890 and losing ground. He's wondering whether he can hold for the next 6 months to 1 year and what the potential upside is from this point. Nilesh, on the charts, what's the view?
See, on the chart, the stock has been in a downtrend. If you see from past almost 1 year, the stock has constantly formed a lower top and lower top formation. But good part is that after this correction, the stock is inching towards his multi-month support zone. And that support zone is placed somewhere around 1770 to 1800. So keeping a stop loss below 1770, one can stay put hoping for a pullback because the stock is still in a downtrend. Only pullback can be seen if at all it moves near about 1900 to 2000. That can be a good exit opportunity because the stock is not moving in an upward trajectory as of now. So looking more sort of a sideways to negative, you have better options within this space. Ambuja Cement and also counters like Ultratech Cement could be a better option. But ACC purely from a short to medium term perspective looks slightly on a weaker side.
All right, so that's a view on ACC. Govind has got the next question. Govind, very good morning. How can we help you today?
Good morning, Alex sir, and all of you. Good morning, sir.
Good morning.
Taking my query is a very honor, sir. Actually, Alex sir, I have one doubt, sir.
Yes, please.
Force Motors, can I observe for last 3 months? The stock is tremendous rally, sir. Is it right time to enter for long term investment, sir? At least I can invest at least 10 lakhs, sir. Actually,
wow.
For
Okay.
a bulk amount, actually.
Okay, so I'm glad
What
that
is the fundamentals and what is the technical?
Yeah.
Where can I enter?
Yeah, and that's an important question that you're asking, and I'm glad that you're asking before deploying a large quantity of money because ultimately when you're buying such a large quantity, Govind, it's important that you get the right price for what you're paying. Let me go across to you, Saurabh. As he's pointed out, it's been a frenetic rally for Force Motors. I'm just wondering whether this is a catch-up rally, whether it is a little too hot, and whether you would deploy a considerable amount of money. Govind is thinking of 10 lakh rupees, or is there a better alternative? I know that people have spoken about the likes of Mahindra and Mahindra, people have spoken about the likes of even Tata Motors because it's a contra bet at this point, considering that it's gone through a little bit of value degradation.
I would not like to recommend Tata Motors as you have said it is a contrarian call. But in case of Force Motors, yes, there has been a tremendous improvement in the operational performance of the company and the profitability itself. I think that is the primary reason that the market is quite convinced that going forward the profitability will be moving like this, the way the company has shown in the last quarter, and that is the reason the stock has got re-rated. My sense is if you want to be in the Force Motor, I think it is better to buy some, like maybe you can divide your investment into 4 or 5 parts and buy in a staggered manner. Maybe you can buy a part at this price, and after every 7-8% decline, maybe you can add more. And with respect to some other company in the automobile space, that yes, Mahindra looks good to me.
Yeah, because I want to establish this fact with you. I want to talk very briefly about the valuation metrics as they stand right now. As I see, the trailing 12 months price to earnings for Force Motors is at 35 times, whereas for Mahindra & Mahindra, it's at 30 times. So given the kind of relative growth that you would see, and assuming that the tractor segment grows better than it has in the past, if the monsoons are normal, then wouldn't this be a better pick, Saurabh, in your opinion?
I think Force Motors, the business is only in a segment like trucks and and the tractors, and in this segment there is a possibility of higher growth than Mahindra will see.
Okay, fair enough. All right, so Govind, that's the point. Don't deploy whole hog into Force Motors. Look at the price and look at declines to accumulate. And of course, M&M is also an opportunity for you to consider. Diversify your holdings. That's the best approach to have. We have to slip into a very quick break. We've got more on the other side, so do stay tuned.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Imports become the exception rather than the norm, and increasingly we do almost last year, for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true, and today private industry can really increase their involvement.
Welcome back. You're watching Ask Profit, a show that gets all your stock related queries answered. For viewers who are just tuning in, you can either call us or WhatsApp us. I mean, you've been doing that already, but that's just a reminder. All right, with that, let's move on with the next query. The next query is from Raja, who is writing in from Hyderabad. He's bought RVNL shares, 5,000 shares in fact, at 50 rupees a piece in November 2022, and wants to know if he can buy more, hold or sell, or even book profits. His time horizon is 4 to 5 years. I'll take this up with you, Saurabh. I mean, he's bought it at very attractive levels. The stock is currently trading at 390 rupees. What would you suggest? Can he continue to hold this for the next 4 to 5 odd years?
See, while he is bought in a very good price, I feel that booking profit will be a wise decision, because after the correction also the stock seems to be highly valued. It is trading at 9 times to book value. And in fact, if you look at the operational performance, the company is not keeping up the growth pace that it should have, considering the valuation it is trading at. So my sense is better to take some money off the deal.
money off the table. Let me very quickly go to Nilesh. Nilesh, on RVNL specifically on the charts, what's the best level to take money off the table?
See, ideally, one should wait for a pullback. Pullback towards 410, 420 could be a good, could give a good opportunity to exit because 200-day moving average is placed somewhere around 420. So the chances are very high we may see a pullback, but better use this pullback to exit from this particular counter from a short-term perspective.
All right, Advait from Kerala has got the next question. Shall be limited is the name of the counter. 198 is the buy price. Given the current market conditions and the company's recent performance, should I consider averaging down, holding my position, or exiting the stock is a question. Do you have enough data on this one to give a view, Nilesh, on the charts?
Yes, I do have enough data to comment on this particular counter. This stock is in a downtrend. First of all, it is trading well below all long-term and short-term moving averages. We have constantly witnessed a formation of a lower top and lower bottom formation as well. So looking at the overall texture of this particular stock, looks like it is moving towards 170 to 160 levels on the lower side going forward. So better to exit from this particular stock on pullback. If you see any pullback towards 185 to 190, that can be used as an exit opportunity because we are not witnessing any sort of a reversal candle as of now. So structure wise looks slightly on a weaker side. Better shift to better options available. This stock looks weak from a short to medium term perspective.
What would those better options be, Nilesh?
See, better option could be, first of all, Bharat Electrical Limited. That's one particular counter we are tracking, and this particular stock has been in an uptrend, and we are expecting further up move to continue towards 440, 450 levels on the upside. So from a short to medium term perspective, can be bought keeping a stop loss below 395. Apart from that, another stock that is Trend. So Trend is also looking positive. From the lower levels, we have witnessed a good rebound in this particular counter, and we are expecting this further momentum to continue this particular stock towards 6,200 to 6,500. So yes, this can be bought with a stop loss below 5,750, and buy and decline should be the strategy here.
Okay, if you could only see Nilesh, if you could only see Mahima's eyes sparkling when you were speaking about Trent, because obviously it's a stock that she tracks very closely, and so therefore the potential upside from here that you were talking about caught her attention. All right, but on that note, thank you so much for joining us this morning, Nilesh. Always a pleasure having you on the program.
Thank you, Alex.
Okay, we will soon be joined by Ajit Mishra of Religare Broking. Ajit, very good morning to you, and thanks so much for joining us this morning. Okay, so this one's an interesting question, and I think it's a good opportunity for me to come to you on this, and I'm going to read it as is, because ultimately these are the questions that our viewers have, and the regular investor would have similar thoughts. And I'm congratulating Rajesh for putting this down, because I think it's important to address. He says it's a generic query. Why is the Nifty overreacting for every news, even though India does not have much impact? The Nifty fell almost 1% today, whereas Israel's stock market is at the year high, or at an all-time high. The petroleum minister has clearly said that we have diversified our crude imports and we have stocked up for several weeks. I don't understand. Now, this is a fair question to ask, but I do want to point out to you, Rajesh, that a move of about 0.8% on the downside for the Nifty 50 is really not too much to write home about. If anything, it's a very measured response to the global uncertainty that we're seeing. So let me go across to you, Ajit, on the charts. What can you tell us about the move today? Of course, to a certain extent, one would argue that the drop that we're seeing is on account of IT, which is underperforming today, and it's moving for completely different reasons.
Yeah, good morning, Alex. So that's true, because if you see, Alex, the top underperformer in today's session, largely they are IT majors and some of the profit taking in the heavyweights, which were under limelight in the last trading session. But Alex, one important thing that I would like to highlight is that this is something not new what we are observing from last 5 weeks. Means every week, especially in the last 3 weeks, we are seeing Friday being a decisive directional move that we see in the index, and in the next following week we said see that move fizzle out, be it on the positive side or negative side, and this is what we are observing consistently. So at the same time, what you rightly mentioned is that yes, today is largely due to IT. and we are still holding above the short-term average. So broadly, if you see, the texture has not changed even after this decline, and the closing is going to be important. So let's say if we manage to close around 25,000 mark, I would rather see this as a very positive close for the market, and probably this week we can see a breakout also about 25,200, which could help the index to inch toward further highs. So texture looks positive. One should not get carried away with the what we are seeing, a global noise and everything. 24,700 when it comes to the Nifty should be your key support.
Of course, keeping in mind the expiries as well. All right, then our next caller, Rahul, is calling in from Jaipur. Rahul, a very good morning to you. How can we help you today? Hi Rahul, can you hear me? Okay, I think we seem to have lost him, but we do have his question. He's holding 1,900 odd shares of Kirloskar Oil, bought at 847 a piece. And I believe I'll take this up with you, Saurabh. What's the view like? We did talk about Castrol India, but I think in the similar fashion, if even Kirloskar Oil might get impacted if crude spikes, what's the outlook like?
In my opinion, I think the company is into the industrial equipment making, and it is a very old company. So the stock has seen a stupendous rise last year, and the valuations have got corrected now. On the operational front, the company is growing at a double digit. In my opinion, I think for the long term, it is a hold.
Okay, it's a hold. All right, we've got a next question on IRFC, and this is from Vijay. I'm not sure where he's tuning in from, but he's bought at levels of 182, and he's got significant quantity, 2,000 shares that he's bought. The stock is currently trading below his buy price at 135, and he's losing about a lakh of rupees. And so he's wondering what to do on the charts. He's got a near-term view. Ajit, on the charts, what's the view on IRFC?
So Alex, he bought at very high levels, maybe close to around August last year. Is something that he made those purchases. And though we were seeing some bit of a buying interest emerging in the railway counters, the lower level last couple of weeks, IRFC is not participating in similar quantum. So it's going to be a very gradual journey for IRFC. And the first hurdle exists around 150-55 marks. So in case if his view is very short term, I would recommend him to maintain a strict stop at 125, because below that again the bias would turn from recovery to negative, and upside around 155-160 he should review his position.
Okay, all right, so that's the view on IRFC. Unfortunately, buying at high levels, you'll have to widen your time horizon or book losses. Those are the two options that you have available for you. We've got a next caller. Venkat is calling us from Bengaluru. Very good morning, Venkat. How can we help you today?
Good morning, sir, and thank you all who are in the panel for your clarifications. So I have a question on Idea Forge.
Okay.
I'm holding 91 shares at 479.
All right.
Looking at the recent move upwards, so I just want to add some more quantities. And looking at the revenues, I see at the moment for the defense, it is around 5 to 6% only it is contributing. All of a sudden, it came to the picture and it rallied. So now I want to add it some more shares as it is fallen from around 1,200 to 1,300 rupees. So do we still have the margin of upwards? Can we average it here, or it is okay to hold at the moment whatever I have?
Okay. I just want one clarification, Venkat. How long do you intend to hold this for?
I bought it around 6 months before.
Okay.
So I'm thinking one more 6 months. So for the short term, 1 year I have taken it actually.
Understood. Okay. So Ajit, I'll come back to you on the charts. This is a stock, as he pointed out, that has gained quite considerably. In fact, in trade today as well, it is up 10%. And so therefore the question is, and I think other panelists, other experts have pointed out that it's better to average on the upside as opposed to on the downside. I don't know what your opinion on this is. Is this that moment for him to deploy?
So Alex, it's always recommended that you average your profits, or means you rather build on your existing profitable position instead of loss making. So that's always a good strategy, especially if it's a trading position. But since his view is 1 year, 6 month, he bought it at very decent levels. Now the stock have moved up very sharply. We are very close to the resistance, so I would not recommend him to add at current levels. So, cause 690, 700 means 10% is the upside. Downside again, we have the risk that in case if market corrects and the stock also witnesses some profit taking, cause the move was almost vertical from 350 to 630, in last 5-6 weeks. So probably in case if he gets any dip around 600, 550 zone again, that's a good buy, or a breakout above 700. In that case, we can see next leg of the momentum, which could help the stock to inch toward 900 plus level.
Okay, so that's a comprehensive view on Idea Forge. The stock is buzzing, as is the rest of the defense pack. By the way, it's the one sector or index that is doing particularly well in trade today, and it's up. Zentech is up 5%. The index as a whole up about 1.5%. But I do want to tell you about the next show, guys. Because this is Know Your Company. I'm sure that a lot of you have already seen it, and I want to tell you what's up next. By the way, in case you haven't seen this show dives very deep into the fundamentals of one company every day, and these are stocks that you potentially hold in your portfolio, so it would bode well for you if you listen in to these conversations. Mahima is going to be on this show today. It's on V2 Retail, and this is a popular stock. A lot of you have either looked at it or invest in it. Why are they talking about it? The questions that they're asking is the growth that the company is seeing sustainable? Is the pricing that they have sustainable? How quickly can the inventory days come down? Working capital days and cash flow, can they sustain at this point? And the margin outlook, as well as the return on equity sustainability. Of course, Mahima is going to talk about all of those aspects. She tracks the company very closely, but they're also going to be talking to Akash Agarwal, who is a whole-time director of V2 Retail. I'd encourage you to take a look at that entire conversation. It starts at 11:30. All right, the next question we're taking is on Orient Green, and this is now Shoni Lal, who's writing in from Kerala. He's bought a very significant quantity at a price of 20 rupees per share, and this is why you need to be very wary of the stocks that you invest in. Right now he's holding 5,000 shares at a price of 13.29. So the question is for you, Ajit. I'm not sure if there is a fundamental view on this. Saurabh, I'm just checking with you. Do you have a fundamental view, Orient Green?
No.
Okay, so I guessed as much, which is why, Ajit, what is the strategy now? Should he book losses?
So Alex, is a very volatile stock. I mean, since listing, I've been seeing the stock, oscillating sharply, in a very volatile range. And currently, also after the failed attempt of securing its long-term averages, the stock is drifting lower with hardly any volume. So that clearly shows an underperformance. So it's good idea. Definitely, you should book losses and avoid such stocks in future.
All right, avoid such stocks in future is the view coming in on Orient Green from Ajit Mishra. All right, our next caller, Shankar, is calling in from Kolkata. Shankar, a very good morning to you. How can we help you today?
Very good morning, ma'am. See, I'm having 50 shares of EID Parry.
Okay.
But still at 487 rupees.
Okay.
Now, the stock has appreciated a lot.
Right.
I would just like to know whether at this point I should hold on to it or whether I should book profit.
Okay, got your question, Shankar. I'll take this up with Saurabh. Saurabh, he bought at attractive levels, and plus the entire theme of ethanol going around, government raising its targets as well. Do you think he should continue to hold EID Parry or sell and book profits? He's sitting on profits of around 24,000 odd rupees.
I think a lot of cyclicality is there in the business with respect to the sugar price and the ethanol pricing. My sense is because of this huge volatility, I would recommend to book partial profits and hold the remaining.
Book partial profits is the view on EID Parry. Okay, where would you deploy the partial profits though at this point, Saurabh?
I think it is better to park money in the maybe utilities or banking.
Okay.
In the utility space, we like NTPC, and in the banking space, I would stick with the larger ones like ICICI or Axis.
Got it. Okay. So this is actually a follow-up. Vijay is writing in from the United Kingdom, and he's woken up bright and early to tune into this show. He has bought based on another panelist's recommendation, KFin Tech. or rather he sold KFin Tech 50 shares and he's holding 50 more. He's asking whether it has reached its short-term potential and should he sell, or is there more upside available in the short term? The stock is up 4% or thereabouts in trade today as well. So Ajit, the question is for you on the charts, should he book out right now?
So Alex, in my opinion, he should definitely hold, because the texture looks positive. Means after this sharp decline from 1600 to 700, in the last 4-5 months, the stock has formed a strong base while holding above its major averages. And off late, in fact, it has completed a fresh buying pivot. In fact, he can add more if he's planning to hold this stock at least for a month or two, with the stop loss at 1200 and potential target of 1550, 1600.
To hold or even add more at the levels that Ajit mentioned. All right. Now, next caller, Murli is calling in from Bengaluru. Murli, a very good morning to you. How can we help you today?
Good morning to you and all the panelists and anchors. I bought Atul Limited.
Okay.
100 shares at 6,884.
Okay.
And I had a long-term view. And the company has completed its capex of 2,000 crores recently.
Right.
And the chemical industry, probably after 2-3 years of languishing, is on the green shoots are being seen, I'm told.
Right.
So it is yet to reach its best performance of 2022 or 21 financial year, probably in the next 2 years.
Right.
What is your view from long-term point of view? Can I add more?
Okay, Murli, got your question, and as always, you've done your research very well. I'll take this up with Saurabh. Saurabh, Atul Limited, what's the outlook like? Can he add more? He's already holding 100 odd shares at 6,884 a piece.
See, the tough period for the company seems to be over. If you look at the operational numbers on the March quarter number, there was an improvement on both on sequential and year-on-year basis. If you look at the valuations, it is trading at the lower end of its trading band. If you see the long-term period, it is trading around 3 times to book value. I find merit in holding the company, holding the stock, and I would suggest to add more.
Atul Limited. And by the way, Murli, kudos to you for the kind of research that you put into each stock that you're holding. And I've noticed that you invariably have gains in the stocks that you ask us about. All right, so let's move to the next one. We've got Shashikant, who's writing in from Pune, and he's looking for a short-term trade. He's got Yes Bank, 4,000 shares that he's bought at levels of 21 rupees per share. He's incurring a small loss, but he's not too far away from the current market price, which is 19.8 or close to 20 rupees per share. On the charts, let me go to you on this one, Ajit. What is the potential upside here?
So Alex, in my opinion, though we may see some rebound due to the oversold position in Yes Bank, maybe close to around 20.50. But instead of waiting for this rebound, the ideal approach is to shift to the counters which are outperforming within the sector. So Kotak and Axis is something that if the view is short term, we can definitely switch even at current levels. And in case if you wish to continue with Yes Bank, then 19 should be his strict stop loss.
Which is not too far away. All right, so point well made. And I think this is a consensus view, both on the technicals as well as on the fundamentals. Opt for the slightly larger, more established players in the banking and financial space. We've got a next caller, Arvind from Chennai. Arvind, very good morning to you. How can we help you today?
Hi, good morning to you all. I am looking to invest about 1,000 shares in either Vedant Fashions or on Root Mobile.
Okay.
And I am looking for a time period of around 6 months to a year.
Okay.
Would like to know which one would be a better bet.
Got it. All right, since you've established, is there any rationale that you have for selecting these two companies?
I've seen both these stocks correcting without any major negative reviews in terms of their overall financials or fundamentals, etc.
Right. Got it. I got your question. So Ajit, let me come back to you on the charts. Vedant Fashion and Root Mobile are the two counters that he's identified. 1,000 shares of either. Which would be the better bet?
So ironically, Alex, both stocks are looking almost identical on charts. Means a very sharp decline followed by a very tight range of consolidation. Both stocks are witnessing. And Manyavar, which is Vedant Fashion, is seeing bit of a traction of late with noticeable surge in the volume. So that indicates a possibility of consolidation or maybe the accumulation at the lower end. So among these two, Vedant Fashion means Manyavar can be considered. And since his view is 6 months, I would recommend him to maintain a stop also, considering that overall trend is still negative. It's just that we are buying for a recovery. So 710 should be his closing stop loss, and upside around 1000, 1050 something that he can maintain as a target area.
Okay, our next question then is from Shweta Kohli, who is writing in from Gurugram. Her query is regarding GPT Healthcare. She got 2 lots in the IPO last year at 172 and added a few averaging out, but the share is not going anywhere is her problem. And she's saying that should she continue holding the shares that she's already holding, or should she sell at the moment and book losses? Saurabh, I'll come to you on this one. What's the view like?
Won't be able to give you this.
All right. Then, any view on the entire healthcare space as a whole, and which pockets do you like in that in the entire space?
I think in the hospital space, we like Narayana Rudale and maybe Rainbow Child Care.
Any view, Ajit? I know that it's a relatively new listing on GPT. What would you do with it if you got allotment in the IPO? Would you exit at this point?
Yeah, certainly I would, Alex, because if you see that it's been a very volatile trend, since listing, and though we are very close to the lower band of this prevailing consolidation range, but at the same time, the stock has been maintaining lower highs during this consolidation phase. So I would rather suggest not to stick with a stock where I have opportunity loss also, and the volume is also negligible. And in case if it witnesses any bounce also, we have multiple resistance to cross. So it's prudent that she should, exit her position and switch to some counters which are trading in sync with the market trend.
All right. It is time now, gentlemen, to hit the rapid fire round, and you both know what this means. We'll throw as many questions at you over the course of the next 2 minutes. Do keep your answers as concise as possible. Raghunathan has got the first question. Jyoti Labs is the name of the counter, and he's looking for an entry point for the long term. Ajit, on the charts, is this a good time?
Yeah, buy with 275 as a stop loss.
Okay, Power Grid is the next counter. Ramesh Kumar from Coimbatore has 700 odd shares at 189 apiece. Wants a view. Saurabh, your view?
Switch to NTPC book profit.
Okay, PG Electroplast for a view of more than 1 year. Can it be bought at the current market price? Of course, he wants to consider either this or Varun Beverages. Saurabh, what's a view?
Varun Beverages.
All right. IDFC First Bank is the next counter. Sanjay is holding 300 odd shares at 76 a piece and wants to know if it can continue for the next 2 odd months or not. Ajit, your view?
Hold 67 stop loss, 76 first target.
Okay, Paridhi Taneja wants to know about which stock in the energy sector should be invested in at this point. Saurabh, what's the pick?
NTPC.
Okay. Canara Bank is the next counter. Karthik from Visakhapatnam is holding 5,200 odd shares and wants to continue to hold this for the next 2 odd years. Saurabh, your view?
Hold.
Saurabh, Aegis Vopak, do you have a view?
No.
Okay. CG Power, and this is a price, okay, I'm not sure if, can we pull that up? Okay. Yeah, he's bought at levels of 8 rupees. Should he book profit? My goodness. Ajit, what's the view?
Certainly, he should book profits. It's been like almost a vertical move, so definitely he should book profits.
All right, ITC is the next counter. Raju Mazumdar is holding 42 odd shares and wants to know if he can continue to hold. Saurabh, your view?
Keep on holding.
Okay, BHEL, long-term views being sought by Jaya, who's writing in from Bengaluru. Could you enter the price at enter this price? Saurabh, what's the view?
Better to enter LNT.
Okay, the next question is on KPIT. The person is holding 150 odd shares at 1426 a piece. Can he continue to hold? Ajit, on the charts?
Hold 1300 stop loss.
Okay, we're out of time on the rapid fire round, and in fact, it's the end of the program as well. Ajit as well as Saurabh, thanks so much for joining us this morning. Pleasure having you on the show as always.
Thank you.
All right, and like I said, that brings us to the end of this edition of Ask Profit. We leave you searching for the dip. Thanks so much for tuning in. This is NDTV Profit.
That is a biggie. It's on deck.
गोल्ड ग्लास क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर।
Sources in ED seeking explanation on Yuvraj Singh, Harbhajan Singh on why they are endorsing such platforms which are banned by Government of India, and the mule account and Benami transaction, the kind of promotional payout being given to some of the media houses, the ad rates are between 50 crore to 100 crore.
What happens in reality is that under the garb of skill-based game, they end up promoting gambling only.
27,000 crore is what the tax evasion, the top popular betting apps are actually evading. Between January and March alone, they have seen 1.6 billion of traction.
Imports become the exception rather than the norm, and increasingly we do almost last year, for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary sir said is 100% true, and today private industry can really increase their involvement in R&D.
I am very proud to say that we make, in our categories that we have been supplying to our defense forces, some of the best platforms in the world.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term? Buy, sell or hold?
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Imports become the exception rather than.
Hello and welcome. You're tuned in to KYC. I'm Harsh Saita. With me is Mahima Vachajani, and what we're going to do today is we're going to speak about V2 Retail. It's a value retailer and it's in focus because of the kind of stock price action that it's seen over the last year or so. The stock has more than doubled, 2.5 bagger over the last year. But look at the last 5 years. In fact, from June of 2020, and maybe that's a low base, the stock has been on an incredible run. It's up maybe nearly 40x, but to be absolutely precise, 34x since that point. So it's been a phenomenal story that's playing out in front of us, Mahima. And it's important to understand at this point, because FY26 could well be that year where rural starts to participate. We've seen rural under a bit of pressure last couple of years. Can rural start to actually participate this year, given the way monsoon is playing out? But the kind of growth base that the company has built for itself over the last couple of years is extremely high. So my first question, therefore, is can growth sustain on this kind of base? Store levels need to go up for that. Same store sales growth needs to sustain with store levels going up. And you have average selling price, which also has crept up, and that also, can it sustain above that 300 mark, will be the question. Because for full year FY25, it's a shade below 300, but Q4 was above 300. So is that the new normal? Is that the new base? The second part of this is, can growth sustain without discounts? Now, discounts have come down marginally in FY25 on a very, very low base. So that's a positive, but can that sustain? Rural pickup in FY26, if that were to happen, states of UP, Bihar will well benefit from that tailwind, even a Jharkhand, even an Odisha, where V2 retail has a significant geographic footprint, and that will obviously further aid the numbers for it. Factors to consider, especially when it comes to store shutdowns, and they do this very minor tweaks in terms of store shutdowns, but that could well be one of the drags, and you'll want to understand whether that is consistent year after year. I would want to quiz them this year and then thereafter next year as well, to try and understand whether those factors are changing with regard to store competition. Challenges, store shutdowns. Challenges with regard to competition and possibly leading to poor execution. That could well be a risk for this one, because we've seen very sharp growth. They are very steady in their commentary, but any slip up with regard to execution could well hurt the stock price as well as the performance, because it's certainly not trading at cheap valuations on a trailing 12-month basis. The average selling price, the trajectory is what I would want to understand. Margin risks, both on gross as well as on the pricing front. What is the calibration that is possible, and that interplay along with competition. And last off, with regard to cash flow, can that cash flow really sustain? Because in FY25, we've seen two positive things happen. One is your inventory has come down, even though your inventory days have come down, even though your inventory in absolute terms has gone up. And second is your payables have really ballooned, and that has helped working capital days to come down, and that has aided the cash flow from operations. Can that change and reverse? Is there a risk of that, is what I would want to understand. So all of that, but first off, about V2 retail, let's take you through the journey. It's been a large turnaround of sorts, Mahima.
Absolutely. It was incorporated in 2001 and it got listed on the bourses in 2007. It was renamed as Vishal Retail in 2011 after selling the entire Vishal brand, which was loss-making, and that was one of the reasons as to why it was sold. And V2 Retail stands for value as well as variety. In terms of the company, it primarily operates in Tier 2 and Tier 3 cities. So what you were talking about, because the past few quarters have been good in terms of rural spending, because rural has gone up as compared to something like an urban. And that is something that has augured growth for the company in FY25 as well. It caters to the neo-middle class and middle class demographics. So that's their overall audience. Like Harsh mentioned, their average selling price is anywhere between that 300 to 350 odd mark. In terms of their focus area, lowest price given at quality, and of course with wide assortments. In terms of the retail presence, they are present in around 189 stores in more than 150 odd cities and in 20 odd states, and retail area as of March ending stood around 20.27 lakh square feet. In terms of their product design, there is in-house product development with a team of 25 odd designers right now. In terms of how their business is divided, well, it's divided in menswear, which is roughly 40%, ladies wear is 27%, kids wear is 25%, and lifestyle is roughly 8% of the overall counter.
I'm just going to chip in here. Yeah. See, this mix, when I was looking at it over the last 4 to 5 years, hasn't changed significantly. Correct. So we've seen this mix remain as is. and therefore that's just something I want to call out, that this might not change as well into the future, because if it's not changed over the last 4 years when the company has undergone tremendous transformation, this may well be the mix that we can continue to expect as well into the future.
And I think that also means that the company is able to understand as to what the consumer preference is, and their mix is therefore not changing. In terms of geography as well, there are expanding into strong cluster, of course populous clusters like UP as well as Bihar. They're entering into new states like Punjab, Bengal as well as Maharashtra. In terms of their overall footprint, Bihar has around 38 odd stores, Uttar Pradesh 35 odd stores, Odisha 26, Jharkhand 16, and MP and Assam has roughly 13 odd stores.
I again want to chip in here for a bit. So this basically, Bihar contributes nearly 20% of the store count. So does Uttar Pradesh. So these two combined would be nearly 40% of the store count. Just for perspective, they have 190 stores. So it's very important to understand this. The other piece is Odisha also contributes roughly 15%. So if I look at the top three itself, that's above 60% in terms of store concentration. And then if I add this 16 here of Jharkhand, that takes it to nearly
70 to 75
70 odd percent, right? So that kind of really adds up when you're looking at just the top 4 states contributing to 70%.
Correct. And these are the most populous states, right?
Absolutely.
With high rural penetration as well. So I think that is something that is working out well for the company.
Yeah, and then they're saying that 60 to 70% of new stores are also in existing clusters. They will focus in on the existing clusters and they will not go into new geographies. And even if they do, they'll be very cautious about it. So that kind of strategy, they're just focusing on what is working. The question after a point will be, is growth capped beyond a point if it's in the same geography? And if they don't find new geographies, but that's just maybe one of the risks. But anyway,
and that could probably keep their overall sales per square feet metric as well, because that is one of the key metrics to watch out for when we study a retailer.
So the other thing, sorry, while we're talking geography, that really stood out when I was reading up on the company was the fact that their rentals have actually come down in the last 2 years. From 56 rupees per square feet, it's come down to 52 rupees per square feet. That kind of again stood out for me, because what they're saying is we'll focus not on, even within the core geography, they will not focus on the most populous part of the geography. They will go slightly outside where rentals are slightly lower. And cater to the value market. That's the other thing that really stands out. Where have you seen rentals really come off? I mean, commercial, we've seen rentals go up while they are seeing a very different trend, and that's kind of aiding their cost structure as well.
Absolutely.
But sorry, please go ahead.
And aiding their margins as well. I mean, we see that later as well. In terms of their store strategy, like he rightly mentioned, 60 to 70% of new stores are from existing cluster. Plus, I think one thing that's standing out again here is the kind of focus on their private labels. Not every company is able to scale that up. Even Trent has tried to focus on their private labels, and that's something that is working for Trent as a big retailer, whereas your Vedant Fashions, your ABFRL has not been able to do that, but V2 Retail has been able to do that and has been able to scale that as well. In terms of manufacturing, they own a state-of-art manufacturing facility in Noida as well as Bihar. In terms of warehousing also, they're set to add a new 20 crore facility in Kolkata, and they also have an existing Gurgaon hub, which will support their overall future growth. Plus, interesting one here is that they use their own fleet to carry their overall inventory, and it's done. It's like a weekly process that they do. So that is also interesting. I think using that this metric as well, they're trying to have their control over how the company is working out their costs around, and that's how I think they're able to give the kind of guidance that they're giving in terms of margin as well as growth.
Correct. Design, manufacturing and retail, they do all three across the value chain, and that kind of aids the numbers. But let's quickly look at the metrics that we look for with regard to a V2 Retail. We start off with the income statement. We look at the balance sheet, cash flow, shareholding, return ratios, street cred, street coverage, as well as valuations. We'll look at all of those and we'll try and give you a view with regard to each of those parameters. You want to start off income statement, Mahima?
Right, so I'll start off with the income statement. Of course, thumbs up here most certainly, because revenue 3-year CAGR has been an impressive 44%. EBITDA 3-year CAGR has been 61%, and margins also have been on a very good increasing trend. I mean, FY24 they stood at around 12%, 12.2%, which they've scaled to around 13.4% in FY25. Net profit has also grown threefold as compared to where it stood in FY24, and company became profitable, I believe, in FY23. So they've been not just able to maintain the profitability, but also scale in terms of their overall profitability, and that's why overall a thumbs up when it comes to income statement. Even in terms of their operational metrics, it's important to point that out here. Since Harsh was also mentioning whether they'll be sustainable or not is one question, but FY25 same-store sales growth at 43%. I mean, no other retailer has seen this kind of same-store sales growth. Volume growth as well at 43%. Full sales price improved to 89%. Old inventory also reduced from 18% to 5%. Store economics, they added around 74 stores this year, and they plan to add 100 stores every year as per their guidance as well. And the last thing that stood out really well for me was that all of these stores become profitable from the first year itself, and they've said that the break even is at 500 per square feet sale. So that is also a very important thing and very interesting thing that came out of while reading the investor presentation.
500 per square foot. They do 750 to 800 in year one itself.
Yeah.
Thereafter, they scale up to 1000 to 1100 in 2 to 3 years. This is just for viewer perspective so that you have the complete picture on how it goes about. The break even is, of course, 500 rupees per square foot per month. But let's look at the balance sheet now. In terms of equity, it's healthy in terms of the overall equity, the number on your screen. Look at also the borrowing number. Now, mind you, the borrowing number excludes lease liabilities. Lease liabilities typically should be excluded from a rental perspective for a model that V2 retail typically follows. Cash and bank balance around 9 to 10 odd crores. So a thumbs up with regard to where the balance sheet is concerned. You want to talk about cash flow, Mahima?
Right, so healthy set of cash flow numbers as well. Cash flow from operations has nearly grown threefold from 93 odd crores to 223 crores in FY25. Plus the cash flow from operation to EBITDA ratio is also quite healthy at 89 odd %. Net cash flow has slightly decreased, but that is because of what you were mentioning earlier as well, because of trade payables going up. That could be one of the reasons as to why the net cash flow has been impacted, but overall a good set of numbers here as well.
Yeah, and so the other piece with regard to cash flow is that two things have happened. One is your working capital days have come down, and that's largely because your payables have gone up. Want to understand how sustainable that number is? There are reasons why that has happened. Won't delve into that in too much detail, but that's something you want to watch out for because that will impact cash flows going forward. Second, 220 crore odd of capex that is in the pipeline every year, of which 110 crore will be to inventory and another 110 crore in fresh capex for new store expansion. Stores typically take 1 crore or so in terms of capex per store. So 100 stores will likely mean 100 crore. Just kind of putting it out there. I fully aware that there's a lot of data out there, but let's talk about return ratios very, very quickly. Return ratios on an improving trajectory. Can they sustain will be the question. That's the ROCE number, but look at the ROE. It's gone up to 23% this time around. Can that really sustain is the question. At least the number seems to suggest that it will sustain, but I'm giving this a cautious tone and therefore a neutral shareholding.
Right, so shareholding, interestingly here, this is one company where, at least that I have come across where promoters have increased their shareholding over a period of time, which was at 53.6% to now 54.24%. So that shows that promoters believe in the company and are ready to invest in the company. FI holding has, however, come down from 6 odd % to 1.3 odd %. DI holding has gone up in the counter from 0.4 to around 6.7 odd %. And overall public shareholding has slightly come down from the 38.8% mark to 37.7% mark. So I think overall a thumbs up, well held company.
Okay, street cred. Let's look at the last year or so. It's done 154% in terms of returns. So it's been a 2.5 bagger over the last year or so. Year to date up 10%, not a bad return either. And you're looking at 5-year returns of 34x. And therefore we've given this a thumbs up, the street cred. Valuations, Mahima.
Right, so valuations we've given a neutral rating here, and this is solely because it's both ways. The company is slightly cheaper than its peers, but at the same time, at 26 times trailing 12 months, it's not cheap in terms of how valuations are seen. So that's the only reason why we've taken a neutral approach here in terms of how it trades and this is EV to EBITDA, because a lot of other companies like Vedant Fashion or Arvind Fashions are still in losses, and that's why we've taken EV to EBITDA as metrics. But yeah, as compared to something like a Bazaar Style or something like a Vedant Fashion or FRL, it turns out to be cheaper. And interestingly, the FY27 estimated valuations go to around 11.5 times, which is quite a significant and quite an attractive valuations for an investor to look at.
Okay, now let's look at how your street coverage stacks up. Now there's just two analysts covering this one. 55% upside. Just given the limited coverage, we've been cautious. We've given this a neutral. Also, you want to quickly look at what the guidance is, and we've spoken quite a bit about some of these. 100 stores in FY26 over the next 4 to 5 years. They're expected to increase store count by 600 to 700. They're looking at a revenue growth of 45 to 50%. Same store sales growth of around 10%, EBITDA margin of around 8 to 9%. In fact, 2 years from now, the pre-Ind AS EBITDA margin, which is currently at 8%, is expected to go up to 10%. They're expecting ROEs to sustain. They're exploring franchisee model as well, but not under current consideration, but they're exploring it. No plans to enter premium. So all of that, we've given that a neutral. Plenty happening on this front. You want to watch out for all of those factors. Quickly on to how we rate this company. Finally, let's pull out all of the ratings. Let's stack them up and let's see how it adds up. There you go. Those are the 4 parameters. Let's look at the other 4. Let's give it the final rating, which is 6 out of 8. Not bad at all. No thumbs down either. So all positive. Or neutral. So that's the other big positive. But let's go across. We have Akash Agarwal, whole-time director, V2 Retail, joining us. Akash, good having you here. I want to start off with understanding whether this kind of revenue growth clip of 45 to 50% is really sustainable. You're at 189 stores right now. You're on an aggressive expansion spree. 100 stores last year was expected. You did 75. This year also 100. How deep is the market, Akash?
Yeah, hi. Thanks for having me. So to answer your first question, the actual target initially for last year was around 50 new stores.
Okay.
But since we were getting such good response in all the new locations that we were expanding to, and the SSSGs were much better than what we had actually predicted or estimated. So that's why we increased the store opening guidance, and we opened 74 stores. And that is why, in fact, we have increased the guidance for the next few years also. And we are well on track to open 100 stores this year and for the next 3-4 years.
Right. Akash, hi. Mahima also joining in. Just want to get your sense on margins. You did almost 13% ending FY25. How sustainable is that range, and what will be the levers of growth from there on?
So we always try to talk about pre-Ind AS margin. So pre-Ind AS EBITDA was 8% for us last year. And the scope, the levers that we have to increase that and move towards 10% in the next 2 to 3 years. So one would be, leveraging additional stores by using the same head office cost and warehousing cost. So your costs per square feet come down. The second lever is selling more at full price, so having a positive impact on the gross margins. And the third lever is the way we move from 650 rupees to 1,000 rupees. So next target is to move up to 1,200 rupees per square feet per month. So these 3 things, levers, would actually help us move from a pre-Ind AS EBITDA of 8% to 10% in the next 2 to 3 years.
Akash, I want to understand how relevant is rural pickup in everything that you're doing, because rural is expected to pick up in FY26. One, are you seeing signs of that? Are you expecting that to happen? And how relevant is rural and rural growth from everything that you're anticipating in terms of pickup on the per square foot sale that you're penciling in?
So yes, rural is a big market to the customers that we actually cater to. And the good thing is the last 2 years there has been a rural demand pressure, and we've been able to show the kind of growth that we've been showing, more than 30% SSSG for 2 years running. So I think when the macroeconomic picture is better, when the rural demand comes back, then it should obviously positively impact us, and we are waiting for that to happen. But it's not an excuse. Even if that doesn't work, we're still working hard on all the strengths that we have shown in the last few years, and hopefully the momentum can continue.
Akash, just want to get your sense. Last when I was reading your con call, you did mention that the e-commerce execution was delayed because of some technical difficulties, but you are planning on getting into the e-commerce space via your own website. Just want to get an update there as to how the development has taken place, and where do you expect your overall online sales to go as a percentage of your total revenue, let's say 3 years down the line?
So we are making e-commerce just an additional channel for our existing customers. We do not want to burn money in acquiring new customers. And we do not want to do a centralized logistics system. So what we are planning is an omni-channel system where all the inventory at the stores can be leveraged and delivered to the customers in the same city. So hence it reduces a lot of costs, and we save on a lot of return costs also. But even at a mature stage, I would say it wouldn't be a very significant number. The e-commerce would constitute about 5 to 10% of the business after it matures. But like I mentioned earlier during the con call, that we don't want to start it with having doubts over the technology partner or the technology behind it. So we want it to be 100% robust and automated. And that is why the delays are happening, because we're still trying to figure out who will be the best technology partner to take us forward in our omni-channel hopes.
Akash, you're profitable, you're focused on profitability, you're focused on cash flow. Your cash flow has seen a bit of a turnaround in FY25. For viewer perspective, give us that perspective as to what has changed in FY25 versus earlier on the payables front especially, and can that sustain?
So there's a uptick in payables because earlier, so we have a subsidiary which has our manufacturing units. So about 20% of our sales used to be manufactured in-house, and the credit term for our subsidiary was 0 days. But that percentage has come down from 20% to less than 5% now. So that has positively impacted the working capital cycle, because the average credit that we get from vendors is 45 to 50 days. And that is why you're seeing a much better cash flow from the credit working capital cycle.
Sustain, Akash.
Yes, so we target an inventory days of about 90 to 100 days, and we've been able to actually reduce it by 10 days. And the plan in the next 18 to 24 months is to actually reduce it by a further 10 days. And if we are able to do that, and even if we maintain the average credit days that we are maintaining now, we would be able to reduce our working capital cycle by another 10 days.
So your cash flow to EBITDA, just trying to understand, would that be around the 80% number even then, or can you improve that further?
No, that should remain at around this number going forward.
Okay, understood. And what gives you the confidence, Akash, that the market is deep enough to do 600 to 700 stores over the next 5 years?
So there are retailers already with 1,000 stores. I think there are retailers with more than 1,600 stores of a particular brand. So that looking for new locations or new cities is not a problem yet. I think for that we need to reach the 2,000 or 3,000 store number. So till then, it's all about, we have more options that we want to open. So I think India, with the growth trajectory that it's on, and with the booming, middle class, and more people crossing the per capita income threshold where, they have more disposable income. So I think it's all positive, and this number will keep on increasing.
Thank you so much, Akash, for coming in and speaking with us. Completely out of time on this one. Great chatting with you. Here is the rural play, viewers, which is really making the waves, both in terms of stock price returns as well as in terms of the way in which the numbers are shaping up. So you want to keep your eye out on this one. What you also want to do is keep the risks in mind, because stock price run up has been significant. But completely out of time, folks, on this one. Thanks so much for joining us. That's all from both Mahima, myself, as well as everyone who puts the show together. Thanks so much for watching.
imports become the exception rather than the norm. And increasingly we do almost, last year for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true, and today private industry can really increase their involvement in R&D.
I am very proud to say that we make, in our categories that we have been supplying to our defense forces, some of the best platforms in the world.
Markets recover from day's low, still trade in the red. Nifty Sensex show resilience despite Iran-Israel tensions escalating. Meanwhile, Auto wins power, HAL and Bharat Electronics. Zentech acquires 54.7% majority stake in Tisa Aerospace, stock up over 5% in trade. And it's IT that continues to be on the back foot. Infosys declines over 2%. HCL Tech falls 1.5% as well. Brokerages rule out worsening demand. Zee Entertainment plans to achieve break-even in Z5, stock up over 10%. Also proposes a preferential issue of fully convertible warrants worth 2,237 crores. And it's Tata Capital 17,200 crore IPO that got a SEBI nod. Company in fact filed for confidential DRHP and is expected to file updated DRHP publicly soon. Hi there, you're watching Markets at 12 with me, Shreyanshi Singh. Let's take a look at the sectors as well as the stocks that are buzzing away in trade. Before we take a look at the stocks though, let's take a look at what the market is up to. And when you take a look at the Nifty, it's hovering below that 25,000 levels. You've seen a little bit of weakness coming in, so tepid moves coming in as far as most of the sectors are concerned. When you take a look at the list of sectors, it's only media as well as defense and metal holding on to a tinge of green, and tinge of green I say because 0.4% uptick coming in. As far as metal is concerned, defense and media are the ones that are holding on solidly to that shade of green, and on the flip side you have IT as well as auto that are tanking away in trade. Bank as well, finance as well, similar picture coming in for all of those indices. Quickly, let's take a look at some of the counters that are reeling under pressure. So it's Infosys, HCL Tech, HUL, Shriram Finance, M&M, Hero MotoCorp that makes it to that list of losers from within the Nifty 50 pack. And on the flip side, you have a BEL, Trent, Adani Enterprises, Hindalco as well as Bajaj Finance holding on to a shade of green at this point in time. But tell you what, let's get you some more news and updates. And as the tensions in West Asia increase, oil prices in fact have been in focus, seen a spike. Will this hike then be making daily life costlier? What should you be making of it? Sessa is standing by with that answer.
Rising tensions in West Asia have left crude oil prices primed for a surge, and since crude oil is a key input for FMCG companies, consumers can expect an increase in their monthly grocery bills and household expenses in the coming weeks. Now, companies have warned that rising oil prices will drive up their packaging and freight cost, putting pressure on profit margins. To offset these impacts, they are likely to pass the additional costs to consumers, which in turn would lead to higher prices across a wide range of items, including packaged food, beverages, soaps, detergents, and even paints. But to what extent? Well, that remains uncertain as of now. The actual impact will depend on how much oil prices increase over the next 10 to 15 days. Now, this fresh uncertainty comes at a time, as FMCG companies had just begun to see signs of demand revival after 5 consecutive quarters of sluggish sales, particularly in urban markets. Analysts suggest that rising crude prices could derail the margin relief that these companies were expecting from the second half of this financial year, aided by fiscal stimulus announced in the recent budget. The market remains alert as geopolitical developments unfold, with many wondering how long this volatility will continue and what it means for both consumers and companies. We will continue to monitor the situation, so stay with us for the latest updates on this developing story.
Well, absolutely, Sasa. We'll continue to monitor the latest updates that come out. In fact, you do have an Iranian military central command spokesperson who's gone ahead and called US President Donald Trump a gambler. You have new updates, new headlines that we've got to look at when it comes to this particular issue every hour at this point. But tell you what, let's move on. Let's focus in on IT as well, because some of those IT counters are tanking away in trade. A series of top brokerages, in fact, including Morgan Stanley, Goldman Sachs, Nomura, have released their views coming in on the Indian IT sector. Following Accenture's latest earnings, we have Jasmeet who's standing by with the key takeaways.
While Accenture numbers beat estimate, as is the revenue is up by 8% and currently at 17.17 billion, while even net profits are also up, and management has increased their revenue guidance for the outlook from 5 to 7% to 6 to 7%. They have narrowed it down by creating bottom at 6%. But let's understand what brokerages say about the Indian IT. Firstly, we have MK on Indian IT. It says caution spending behavior by client amid elevated macro uncertainties and downgrade in the earning. While they also mentioned there's no further deterioration of demand. So the demand reduction is bottoming out and it can see an improvement, while the earning downgrade cycle is bottoming out. The pecking order top 3 for this particular brokerage is Infosys, TCS and HCL Tech. The next one we have is Morgan Stanley on IT. They say there's no major surprise for Indian IT based on the Accenture results, while the Accenture results are neutral to slightly positive for Indian IT. Accenture showed a strength in the financial services, while they feel it embodies the Indian IT sector as well. The demand environment has remained resilient, while the pickup in discretionary spending is still missing, while the clients have shown inclination towards more larger scale transformation. Then we have Goldman Sachs on Indian IT. While the demand environment has likely not worsened, what they say is, and they say visibility of improvement in limited, while the forecasting is 6.1% YOY basis, and they forecast a 0.4% increase in for September 2025 estimates. The next is Nomura on Indian IT. While they say the demand in financial services hold strong and there is no noticeable change in macroeconomic environment so far, while the Gen AI opportunities continue to mature and see a rise, while they prefer Infosys in large caps and Coforge in mid caps. It'll be interesting to watch out how the Indian IT results turns out in the coming months.
Absolutely. So that's the take coming in as far as some of those brokerages are concerned. Tell you what, let's take a look at some of those counters as well, because some of those counters are tanking away in trade. Let's take a look at HCL Tech as well as Infosys as well, because those are the counters that are down in trade. As you can see, a tinge of red coming in on your screens as well when it comes to some of those counters. Tell you what, let's go across and listen in fact, move on, take a look at what the defense pack and the outlook for the defense pack then looks like. India's defense capex has more room to grow, and that's the word coming in from Mahesh Tandurkar, who's the head of research and MD Jefferies India. Let's go across and listen into what he is penciling in.
As far as India's defense expenditure goes, I would say that the defense capex as a percentage of GDP today is at about 50 basis points. Over the last 20 years, if you see, it has ranged between 50 basis points to 1 percentage point of GDP. And given all the geopolitical tensions all around the world, also in the subcontinent, I think even for India, it needs to be towards the higher end of the historical range and not the lower end. So my sense is that over the next 5 years or so, I would expect India's defense capex to be rising by 25% CAGR. And plus, on top of that, there are other things like Make in India, and there are some small examples of Indian armaments being exported as well, etc. So there is a pretty strong growth outlook for many of the companies that are involved in this defense space. And I hear what you said completely, that the valuations are rich and it's going to take some time for the order book to grow and etc. But I think from a thematic perspective, it still makes sense to be positioned in that space.
Or rather, more room for the defense space, in fact, the capex to grow, and that's the word coming in from Mahesh Nandurkar as well. Tell you what, let's focus in on some of these defense counters that are buzzing away in trade. Zentech, that's the one that is up about 5%. Bharat Electronics as well. Let's take a look at some of those counters. In fact, we have Anushi who's standing by with an update on why exactly these counters are buzzing away in trade.
Right, so the focus has remained on the defense counters that we are seeing today, and this is on the back of some order wins in some of these counters. Firstly, I'll start off with Bharat Electronics here. The company has got additional orders worth about 585 crore, and these orders pertain to fire control and sighting system for missiles, communication equipment, as well as jammer spares and air services. Now, do note that the company did a margin of around 29% in FY25 and is on a steadfast route to continue this margin trajectory going forward, with FY26 target being a 27% of a margin. Other than that, even in terms of where the order picture is considered, they're seeing about a 57,000 crore of order inflows. Of course, this includes the 30,000 crore of a QR-SAM order as well. So that one would be an important one to watch out for. Now, the second counter in focus is HAL, Hindustan Aeronautics. Now, it's been bid for manufacturing small satellite launch vehicles developed by ISRO. So this is a new opportunity and foray for HAL, as well as this is one of the first given by ISRO to a company like HAL for this kind of an order. 511 crore is the kind of order opportunity that we are seeing for HAL on this. So a smaller order size, but a significant development that we are looking at. If you look at the order book positioning, that's about 1.84 lakh crore, a 95% of a jump from last year. Coming finally to Zen Technologies now, they've acquired a majority stake in TISA Aerospace. So TISA specializes in Indian development loitering munitions along with UAVs, that's unmanned aerial vehicles. So again, this move is in Zentech's line for expanding their foray into the drone technology that we're looking at. The company already has a strong presence in anti-drone space. So that is an important development that also we are seeing. So all these counters in focus on the back of order wins along with some acquisitions.
Well, absolutely. All of those counters, all of those defense counters in focus. Zentech up over 5%. Even Bharat Electronics is buzzing away in trade, as you can see on your screens as well, for some of those moves coming in for those counters. But tell you what, let's shift focus to the diagnostic space. Now, you can be booking instant, doorstep sample collection in under 60 minutes, and that's good news for customers. I'll tell you who it is bad news for, though. It's diagnostic companies. Those are the ones that are in focus on the back of this being bad news, because Amazon is a key important player that is there in this particular market. Varsha is standing by with some more details.
Thank you for that. So yes, Amazon has entered diagnostic market. Now they have launched their first ever home lab testing services in India. Now what they're going to do is that customer can now easily book lab tests, schedule and track appointments, and instantly access digital reports through the Amazon app. They've also promised doorstep sample collection in under 60 minutes, and the digital reports for the routine test will be delivered in as little as 6 hours. Initially, these services will be available in 6 major cities, that is Bangalore, Delhi, Gurgaon, Noida, Mumbai and Hyderabad, covering over 450 pin codes, and they're going to offer a selection of over 800 diagnostic tests. The new service called Amazon Diagnostic has been introduced in collaboration with Orange Health Labs. Now, why Amazon is doing this? Because they're going to, so of course the diagnostic industry itself is going into a double digit. Who would not want to go into such a a big market? Number one. Number two, they are also building integrated healthcare, and unifying services under Amazon Medical is one of the reasons why Amazon is doing this. On to key differentiating factors, so they will be having a rapid sample collection, timely report delivery and strict data privacy and quality standards. A real-time slot visibility would be there, map-based address validation and secured digital report access via the Amazon app are some of the key differentiating features that Amazon will be giving. Lastly, if you see, few stocks are under pressure in today, that is you have Dr. Lal Pathlab, you have Metropolis, you have Vijaya Diagnostics, and all the Indian diagnostic companies are actually under pressure because now Amazon has come into play. Now we all know that Amazon has that access when it comes to delivery infrastructure that Amazon has already set in, and with this partnership with Orange Lab will actually will be a disadvantage when it comes to overall your diagnostic companies.
Well, absolutely, it's bad news coming in for diagnostic companies, but just like Varsha said, it's a very big opportunity coming in for Amazon because it's a very big market there. But tell you what, let's also get you a list of the other counters, in fact, that are buzzing away in trade. Anushi joining us yet again with that list.
Okay, so the first counter is Bajaj Projects. Now, this is in focus on the back of a ultra mega power transmission order, the size being 400 crore over here. And this order pertains to building a new transmission line of around 138 kilometer. Again, if you look at the execution period for this, that is roughly around 29 months. Taking that in consideration with how the company did in terms of revenues last year, the company had clocked in a revenue of 2,500 crore in FY25, and the company has a market cap of around 2,333 crores. So it's a significant order that we are looking at for Bajaj Projects. Along with that, Interact is also the other stock in focus on the back of another order win. They've won a 80 crore of an order from Aether Energy, and this is for design, engineering and supply of pre-engineered steel building systems. Execution period being 9 months for this one. Just on that note, even if you look at the FY25 numbers, revenue was about 1,454 crore, and this was with a 9% of a margin that we are looking at. Company market cap is around 3,400 crore. So not a substantial order win that we are seeing, but still a significant one for Interact. That's why the stock is in focus today.
Alright, then those are the two counters that you should be watching out for. They're the ones that are buzzing away in trade. But tell you what, let's also take a look at some other important news and updates coming in. And let's also take a look at Tata Capital. In fact, because speaking of action from the primary markets, you do have Tata Capital that has in fact now gotten an approval coming in from SEBI on the confidential IPO papers as well. Agnidev Bhattacharya joining in with more details.
So SEBI is likely to have approved Tata Capital's confidential draft papers that it had filed in April for its IPO, which would have been worth about $2 billion. Now, the company is expected to file an updated DRHP publicly with SEBI after this, as is the regulatory norm. Now, the IPO is expected to be a combination of both fresh issue and offer for sale, with the fresh issue being of up to 23 crore shares. And Tata Capital is now mandated to be listed on the exchanges by September of 2025. So this is one of the procedural steps that the company needs to go through before its IPO. And remember, we had reported earlier that the file for Tata Capital's confidential DRHP sat at the SEBI chairperson Tuhin Kantas Pandey's table, waiting to get approval, as is the norm with such big ticket IPOs. And Tata Capital is the latest in the line of another few big NBFC IPOs which are lined up for the year because of this RBI regulation. Other IPOs in the NBFC space which are coming up include Hero FinCorp and HDB Financial Services. So we will keep bringing you more updates about Tata Capital as and when they come in, so do stay tuned.
Well, absolutely, that's a 17,200 crore IPO coming in as far as Tata Capital is concerned. We trust you to get us more details, Agnidev. But tell you what, moving on, let's take a look at some of the other counters that we have as well. Zee Entertainment is the one that is also in focus. But before we get you some more details on that, tell you what, let's take a look at LT Foods. That is in focus after the US imposes around 340% duty on soybean meal exports as well. How is the stock going to be reacting? Mahima is joining in with that update.
Right, so as you rightly mentioned, so what US has done is they've imposed a 340.7% countervailing duty on LT Foods subsidiary, that is Ecopure Organic Soybean Meal Exports, and this is generally such high countervailing duty is only imposed when the company, when asked for certain information, does not provide that information. Either it's inadequate or it's not provided on timely basis, and this is because of this, the stock could see an impact. Now the company does not really mention as to what kind of transaction it does with this particular subsidiary, but Ecopure in its filing did say that it will evaluate the legal remedies available for the counter and will take action accordingly. But the stock is down almost 6% as we speak today on the back of this, and this could probably hamper their overall workings in US per se.
Well, absolutely, that's LT Foods that we're talking about. But tell you what, let's also take a look at the blockbuster week that we have in fact lined up for the primary market. We have 17 IPOs set to hit the D Street. 6 of them are going to be main board issues, 11 SME offerings as well that we're looking at, Mahima. So tell us about all of those as well.
Right, so as you rightly mentioned, there are going to be 6 main board IPOs and 11 SME IPO issues in this particular week that are set to raise around 15,800 odd crores itself in this week. Now, to talk about main board IPOs, HDB Financial is the first one on the list. It's basically a retail focused NBFC, and the IPO date starts from 25th of June, ends on 27th of June. It's a total issue of 12,500 odd crores, and price band is set between 700 to 740, and the minimum lot size is 20 shares here. The next one is Sambhav Steel, which is a manufacturer of electric resistance welded steel pipes. This also opens on 25th of June and ends on 27th of June. The issue size is 540 crores and price band is 77 to 82, and the lot size is 182 shares. Then we have Kalpataru Limited also opening its IPO this week. It starts on 24th of June, ends on 26th of June. The total size is 1590. It's basically a real estate development company which is based out of Mumbai. The price band is set between 387 to 414, and the lot size is 36 shares for Kalpataru Limited. The next one is Ellenberry Industries. This is specializing in production and supply of industrial as well as medical and specialty glasses. The IPO opens on 24th of June, ends on 26th of June. The total size is 852 crores, price band between 380 to 400, and the lot size is 37 shares. Lastly, Globe Civil Projects, again another 119 crore IPO. It's an EPC company, opens on 24th, ends on 26th of June. Price band is set between 67 to 71. And Indo-Gulf Crop Sciences is also set to open its IPO on 26th of June, which will end on 30th of June. The issue size here again is 119 odd crores, and in terms of SME IPOs, a lot of SME IPOs will also be opening their IPO with the BOSes. Plus there's Ares Infra Solutions that is set to list on 25th of June. So a lot of primary market action this week certainly.
Well, absolutely. That's something that we're slating on our calendars. Lots of primary market action. But tell you what, before we wrap on this edition of Markets at 12, let's get the chart of Z Entertainment on the screens as well, because that is the counter that is buzzing away in trade. On the back of that strong commentary coming in on plans to achieve break-even in Z5. So that's Z Entertainment as well up on the screens for you. But tell you what, let's also focus in on arcades that are they just relics of the past, or do they still have relevance in India time zone? India, in fact, has relaunched their flagship arcade at Inorbit Mall in Mumbai. But why now? Agnidev is joining in, who spoke to the CEO as well to get all of us a little bit of a sense on this. Take a look.
Arcades. You thought that these were things from the past, relics from a bygone era, which were only being used as cliches from horror shows from the 90s. But what if I tell you that this arcade is not just launching, but relaunching with a wider carpet area? Time Zone India claims to be Asia Pacific's largest chain of gaming arcades. How big is that? It's big. And today they are relaunching their flagship operation here in Mumbai's Inorbit Mall. But why now? Why will a gaming arcade be relaunched in India when they are closing all over the world? And to answer this question, we got hold of Time Zone India CEO Abbas Jabalpurwala and asked him this very same question while forcing him into a bumper car ride with us. So Abbas, why do you think gaming arcades still have so much relevance in India today?
So what is changing in India is the growing middle class. As it continues to grow and disposable income rise, people are looking at avenues to spend quality time with their family, whether you are a group of friends or family, or you want to spend time with your child. So what better place than this than an arcade where you get to relive your childhood, meet your friends and have fun.
Well, if it wasn't obvious from what Abbas just said, gaming arcades are clearly a big thing in India. A JLL report from 2024 says that India has 6.6 million square feet of operational gaming arcades spread across the country. That's as much as 33 cricket fields. These gaming centers are spread across 500 different zones in 83 cities. And the segment is expected to grow 67% to 11 million square feet by the end of 2028. So relevance, that's there. But what about the money? Do gaming arcades just make enough money to justify this huge of a setup? And how good are the margins? To answer these questions, we strapped Abbas into one of his own rides. And he has been more or less kind enough to break this down for us. So Abbas, tell me, what are behind the business tactics of a gaming arcade like yours?
Arcade business is a very capex intensive business, as you know, we can see it around. Any good venue that pays us back in 2.5 to 3.5 years, considered to be a good investment. And with our 21 years of experience in the country, we now have enough and more data to basically identify a good location and make sure that our investments that we do are paying us back in the threshold limit that we have.
But gaming arcades are also booming in India because, well, it's India. And as the age-old saying goes, any place is fit for a date if you are Indian enough. Instagram today is full of content which suggests that gaming arcades are the perfect place for your online date. Just you, them, and some crazy competitive energy. But is this the same demography that Abbas targets? Third time's the charm, and we have got Abbas yet again to tell us what kind of an age group he targets with his gaming zones. So Abbas, do tell us more about this.
Look, we want to appeal to everyone who is 5 years to 50 years and beyond. And that's exactly what this venue truly represents. And apart from that, we also wanted to become a destination which becomes a go-to place to celebrate your special occasions, whether it is birthday parties or anniversaries. And that's why we have this multi-seater party room which can cater up to 100 guests. So when you get hungry, then that's where we saw that, okay, let's have an in-house cafe. And that's the whole thought process behind why we have the cafe and the demography. And that explains the demographic that we are looking at.
While the surge of multi-age oriented entertainment demands continue to rise in India, we can always expect more standalone gaming arcades turning up across Tier 1 and Tier 2 cities. But ultimately the bigger question remains, will I be coming back to this arcade for another bout of Skull of Shadow? Seems likely.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Imports become the exception rather than the norm, and increasingly we do almost last year, for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true, and today private industry can really increase their involvement in R&D.
I am very proud to say that we make, in our categories that we have been supplying to our defense forces, some of the best platforms in the world.
Sources in ED seeking explanation on Yuvraj Singh, Harbhajan Singh, on why they are endorsing such platforms which are banned by Government of India, and the mule account and Benami transaction, the kind of promotional payout being given to some of the media houses, the ad rates are between 50 crore to 100 crore.
What happens in reality is that under the garb of skill-based game, they end up promoting gambling only.
27,000 crore is what the tax evasion, the top popular betting apps are actually evading. Between January and March alone, they have seen 1.6 billion of traction.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold
CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world.
Hello and welcome to NDTV Profit. A very good afternoon to all the viewers. You're watching Profit Buzzers. I'm Hiral Datia and with me is Varsha. Varsha, good afternoon. An interesting day of trade, a mild recovery that we're seeing in the markets. But what's interesting is some bit of resilience that we're picking up with regards to Israel-Iran war, with the US entering in as well. Let's quickly look at what markets are doing at this hour as we speak. If you see in terms of Nifty 50 as well, it is under pressure, trading in the red, but overall, currently, that from the day's lowest levels of 24,824, it's hit a high of 24,988, inching towards that 25,000 mark pretty closely. We're just around 50 points away from that level, so it's going to be interesting to see where Nifty ends in trade. Let's pull up Bank Nifty as well, and then the sectoral indices to see where the pressure point is. 0.6% kind of a cut that you're seeing with regards to Bank Nifty as well. And it's the private banks, and if you pick up the PSU banking index, that will tell you the story as to where the pressure is coming from. There you go, 0.2% lower on that front. Let's pull up the sectoral indices heat map to understand that trend on that front. Media is the top gaining sector. Defense is seeing some smart gains. Metals up in trade as well as we speak. Consumer durables and pharma, which is in the positive side. What's under pressure is Nifty IT, and that is taking cues from the way Accenture numbers have panned out. What's interesting is the guidance, but the brokerages have been absolutely gung-ho with regards to IT as a sector, taking cues from Accenture. But it'll be interesting to see how the day pans out there. Auto is also slightly under pressure in today's session. FMCG seeing cuts of around 0.6%. And you have Nifty Infra, which is also down in trade. But let's quickly look at what OMCs are also doing, because energy sector is taking a marginal beating to the tune of around 0.2%. Let's pull up the heat map in terms of individual stocks on Nifty 50 or even the contributors, because that will also give you a fair bit of an idea as to what's happening in terms of individual stocks. BEL on an order win is the top gainer today. Hindalco seeing some smart moves. Adani Enterprises is also up in trade, and the reason that stock is buzzing in trade because they've actually commissioned their first off-grid green hydrogen pilot plant of 5 megawatt capacity. We'll talk in detail during the show. HDFC Bank, Infosys, ICICI Bank and Reliance Industries are the ones which are taking the Nifty 50 on a downtick. Interesting is the kind of moves, Varsha, that you're seeing in the broader markets, right?
Yes, actually, broader markets are actually in green. If you see Nifty Midcap 150, it's up 0.3%. And on the gainer side, though, you have MRPL, Poonawalla FinCorp, Dixon Tech, KEI Industries, and Linde India, which are buzzing when it comes to Midcap 150. On the loser side, though, you have Astral, you have Godrej Industries, Tube Investments, and Patanjali Foods, which are on the losing end when it comes to Nifty Midcap 150. Let's see what small cap 250 is doing. It's up almost 0.5% in trade today. You have Chennai Petro, you have K Fintech, you have VIP Industries, ITI, and Glenmark Pharma, which are buzzing in trade today. Well, Glenmark is buzzing on the back of Investec initiating a coverage on the stock. On the losers, though, you have Sterlite, you have Varroc Engineering, you have Ratan India, and MTAR Tech, Godavari Power, which are on the downward side when it comes to small cap 250. So overall, if you see broader markets, yes, are in green today. But well, on the biggest story of the day, Iran and Israel conflict has taken another turn, with Iran proposing Hormuz closure post US markets. Listen into the veteran Ramesh Damani and expert Ajay Bagga's take on market post these escalations.
I'm generally having a more optimistic view of financial markets given what happened over the weekend. I think another way to look about this conflict between Israel, America and Iran is to look at bark versus bite. And clearly, I think events as they've unfolded have proved that Israel and America have bark and bite, whereas Iran has only bark. So my sense is that it was a very monumental decision that President Trump made over the weekend, but it has completely changed the contours of the Middle East. And I think investors can look ahead to an area of peace, prosperity, FDI flows in the Middle East.
A really very tough environment for traders, good environment for investors, and best environment for SIP investors who have just disciplined in a disciplined manner kept investing. They are the real winners of this year. Everybody's forgotten July 9th Trump tariff deadlines. Everybody has forgotten the big beautiful tax bill which is meandering through the Senate, and this has taken precedence. Total GDP of Israel and Iran put together is 1% of the globe. If Iran's oil goes out of the global supply, the Saudis and UAE themselves have more than enough capacity to ramp up. But if you look at the Israel bombing, they have bombed the Iranian internal storage oil depots. They have not touched the Iranian export terminals. So the Israelis also have some kind of a tacit agreement with the Chinese, who get 15% of their oil unofficially from Iran, that they will not hurt Iranian exports.
Right, so that's the word coming in from market veterans and Ajay Bagga as well. But let me also welcome in Sharmila Joshi, founder at sharmilajoshi.com. Sharmila, good afternoon and welcome to the show. My first question coming to you is, how are you seeing Indian markets in the context of what's happening globally, from the war to the kind of impact crude can see? And just a week before all of this, you had emerging markets which saw a huge inflow. I think, if I'm not mistaken, Taiwan was on the top of the list, followed by India in the form of ETFs. So there is fund that is moving into emerging markets. There are geopolitical concerns. Crude right now is not a major concern till it crosses that $80 per barrel mark. How would you advise investors to maneuver in this kind of a scenario?
It's a difficult scenario, all said and done, because I think just last week we were beginning to hope that things have taken a turn, and a lot of the moving sort of pieces that are there are now settling down. And now we've had a new sort of a geopolitical tension that has taken over. And my feeling has been over these last couple of months is that we need to be able to deal with these kind of uncertainties better going ahead. Because if everything that has happened in the last 4 or 5 years is anything to go by, it is clearly showing that that the kind of periods where we used to have where markets are sort of going up in a directional manner, they seem to be getting those periods seem to be getting compressed, which I think makes life very difficult for traders. So I think in a market like ours, where we are definitely seeing long-term sort of possibilities in terms of where the economy will get to in a period of 3 or 4 years, that's how you need to position yourself. So it's a very difficult time for traders. I really don't know what are the strategies they're using. But for long-term investors, I think the strategy would be to sort of buy on when you get dips. And try and buy with a horizon of 3 to 4 years, and be in sectors which are at the moment sort of more domestic focused. But I think if things change, then obviously we will look at export facing sectors as well. But the theme should be long term.
Right. Thank you so much, Sharmila, for that view. Well, we all know that the crude oil prices have surged after US attack on Iran. Now, how this will impact which sectors and how this will impact the overall sectors, Mahima joins in with more details.
Right, so I'll start with paint companies, because crude is a key raw material for paint companies, and cost of crude as a raw material could make up to 30 to 35% of their overall raw material price. And because they use crude derivatives, crude prices going up is a negative for this counter, and it might impact their overall margins as well as profitability. Now, stocks that could get impacted includes Asian Paints, Kansai Nerolac, Indigo Paints as well as Berger Paints. The next one is aviation. Of course, because of crude prices going up, your aviation turbine fuel could get expensive, and higher crude could impact the overall margins for these counters. That includes your Interglobe as well as your SpiceJet. Then we have tire companies, where tire industry is used following crude derivatives for raw materials that include synthetic rubber, chemicals as well as carbon black, and crude derivatives in tire also roughly amount to 30 to 35% of their overall raw materials. Now, stocks that could see impact includes Apollo Tires, JK Tires as well as Seat. Lubricants like Gulf Oil and Castrol India might also get impacted, because they use direct crude derivatives like base oil as well as additives, and for them around 40 to 45 to 50% of their overall raw material constitutes of crude derivatives. Lastly, plastic and packaging as an industry also might get impacted, because polymers as well as polyethylene are direct crude derivatives, and a rise in crude prices could impact their overall margins as well as the profitability. So stocks in focus could be Polyplex as well as Uflex and Jindal Poly. Now, of course, one thing to keep in mind is various experts are suggesting that this impact will only take place once crude crosses that $85 per barrel mark. Till then, the impact will not be much. So this is the overall view as to how rising crude prices can impact various sectors.
Thank you, Mahima, for all of that, because interesting moves that you're seeing in individual stocks as well. But you have shipping companies which are buzzing in trade. So you have the likes of SCI, that's Shipping Corporation of India, and GE Shipping. Both these counters are up in trade today if you see the charts. And if let's just look at a 1 month chart, because that will give you a trend. Since the time crisis have started, you've seen that spike that has come in with regards to where shipping majors are concerned. 1 month, 12 to 13% on this one, and GE Shipping is another one which you should be watching out for. 5.5% is the last 1 month is the kind of gains that you've seen. And this is because your freight costs have surged, and this is as Indian exporters are abandoning Red Sea route amid the West Asia tensions. Pankaj Chadha, the chairman of Engineering Exports Promotion Council, spoke exclusively to NDTV Profit. My colleague Rishabh joins in with the key takeaways. Rishabh, over to you.
Right, what we've learned from conversations that we've had with exporters is the fact that Red Sea, the trade routes through Red Sea are now closed. That is not something that Indian exporters are preferring at this point in time. What we're seeing is that now shipments are being rerouted through the Cape of Good Hope trade route that is via the African route instead of going through the Mediterranean. That means that exporters now face an additional 20 days of voyage for all of these shipments that are bound to either Europe or the West in general. That means 20 days of extra voyage. That also means extra shipping costs. And what Pankaj Chadda of the Engineering Exports Promotion Council tells me is that they are seeing freight costs go up about 30 to 40% from what they were sending shipments earlier with. Apart from the cost angle, there is also the issue of in general just the uncertainties on whether containers will reach, given the fact that there is tensions that are developing and that are brewing day in day out, especially over the weekend with the US also formally entering this conflict. What we're also seeing is that exporters are also, of course, constantly tracking oil prices, which are also set to go up. They have gone up as of Monday, but they will further inch up if these tensions worsen.
Thank you so much, Rishabh, for that. All the three stocks buzzing in trade. Sharmila, let's look at the shipping companies. Let's look at companies that get impacted on the back of higher crude prices, if at all. Which companies would you advise to buy, if yes, if any? And any companies which get impacted on the back of higher crude prices, would you advise to sell?
So I think that clearly GE Shipping, I mean, in this current environment, for me, that's the stock that stands out, because I think Garden Reach and Cochin Shipyard, Mazda, we were already buying on the back of good orders and the fact that, the defense theme and overall we have a sort of focus to improve our presence in the seas. So, those stocks, I think, should definitely be on your list. They have, however, gone up a lot, and so you need to temper down the kind of gains that you think you'll get there. But from this current conflict, I think GE Shipping seems to be the stock that could benefit. Clearly, for the reasons that you mentioned, that dry freight costs are going up, and I was just quickly having a look at the valuations of GE Shipping, and they seem reasonable. So if this kind of period extends itself, which at this point in time it shows every signs of, then this could be the stock that could benefit from that.
Right. Thank you for that view, Sharmila. Now shifting our focus to IT sector, a series of top brokerages including Morgan Stanley, Goldman Sachs and Nomura have released their views on Indian IT sector following Accenture's latest earnings. We have Jasmeet joining in to tell us more about that.
Well, right, Accenture's numbers beat the estimate. While we see the revenue is up by 8%, but the new bookings have declined by 6%. While the management has also increased the revenue guidance from 5 to 7 to 6 to 7, basically they have narrowed down as bottom as 6%. Now let's understand what does brokerages say on Indian IT and how they read the crossover from the Accenture's result. First we have is MK on Indian IT, where they say no further deterioration in the demand environment. While the earning downgrade cycle is bottoming out, the pecking order for top 3 from them is Infosys, TCS and HCL Tech. The next is BNK on Indian IT, while they say the clients are aggressively pursuing on cost takeout opportunities, that's why the revenue. Next we have deal wins constitute to dominate the whole cost takeout scenario, while they feel the BFSI have a strong momentum. They prefer Infosys, TCS, Persistence and Coforge. While next we have is Morgan Stanley on Indian IT. They say there is no major negative surprise for Indian IT, while the demand environment has remained resilient, while pickup in discretionary spending is still missing. We have Goldman Sachs on Indian IT. What they say is visibility on improvement is limited, while their forecast is 6.1% for FY27, while the forecast for next particular quarter, that September 2025 estimates, is 0.4%. Next we have is Nomura on Indian IT services. They say the demand in financial service still holds strong. Gen AI opportunities continues to dominate and gradually improve, while they prefer Infosys and Coforge. The lastly we have is Nuvama on Indian IT, while they maintain a positive stance on the sector from medium and long-term perspective, and they also say recovery in microenvironment to accelerate the enterprise tech spending. It will be interesting to watch out how this result turns out for the Indian IT in the coming quarter.
Thank you so much, Jasmeet, for all the details. Well, Sharmila, just wanted your view on overall Indian IT sector. Which are your picks and your view and your take on Accenture's earnings?
So the earnings, obviously, I think were good, and really speaking, the guidance came as a sort of a good surprise in that sense that they improved it a little, or rather narrowed it to 6 to 7. So that I think is a positive. And I think as all these sort of the various reports that you all were talking about mentioned that the visibility going ahead, nobody's really talking too much about that. We have July 9th in any case looming ahead of us, and this whole US tariff issue, we need to see how that plays out. Indian IT companies themselves have been very circumspect when they've given their guidance. They've spoken of like 3% and thereabouts, like absolutely low single digits. So in that sense, perhaps not as positive on the sector as one would have otherwise been. Once that environment improves, I think I'll be more positive. But however, I think prices have corrected. In the large caps, I like an HCL Tech, and then I think you need to look at some mid cap names. I think there you could possibly find more stocks that I like. I do, for instance, like a Zensar at this price, Persistent Systems, LT Mindtree. So stocks like that. And again, the view needs to be long term, but more sort of stocks of interest in the mid-cap space rather than the large cap.
The mid-cap is more preferred in terms of IT versus the large cap. But moving on, what's interesting is all the geopolitical turmoil that is going around. Whilst all of this is happening, Bernstein has actually signaled optimism on India's economy, and they've highlighted its resilience amidst the global headwinds. They've actually gone ahead and identified key stocks which could probably poised for growth. Somit brings in more from their report. Somit, over to you.
Well, yes, a couple of weeks back, Bernstein had gone bullish on mid-caps over large caps, and now this report has come in where they're saying that is the right time to invest in mid-cap stocks, given the fact that, given the current global scenario will not have a structural impact on India. They're saying that any dip could be an opportune time to invest in India's mid-cap, and they have highlighted, or they have listed out 10 such mid-cap stocks which where investors could look into over the next couple of quarters. Firstly, they are bullish on Coforge. They're saying that the high deal momentum is expected to drive robust growth for FY26. They're also bullish on KPIT Tech. They're saying that the company is positioning itself for a potential positive surprise for FY26, even without explicit double-digit growth guidance that was given by the company. When it comes to Persistent, they are saying that the company boasts a robust deal pipeline and a strong diversified client portfolio, which could turn out to be which could lead to a strong quarter or strong quarters for Persistent going forward. Delivery, they are saying that the negative impact of e-commerce insourcing appears to be plateauing, which could unlock volume growth going forward. They're also bullish on Renew, but do remember that Renew is not listed directly in India. So apart from that, it's Paytm which they're bullish on. They're saying that the company is poised to achieve PAT profitability in the next quarter, and apart from that, they'll also bullish on the fact that there is regulatory support coming in, and also a rebound of merchant lending that they're saying when it comes to Paytm. For Max Financial, they're saying that the growth and margin expansion is something that the street is anticipating, and this could follow through post the merger that has been completed with Axis and Max. Rebranding has also been done currently. When it comes to HDFC AMC, they're saying that the AMC is well positioned for market share gains and potentially higher than street estimates when it comes to asset under management growth, that is AUM growth. For Jubilant Food, they believe that the company plans to open around 1,000 new stores by FY28 and are expected to enhance delivery capabilities, which will in turn also lead to higher margins for Jubilant Foodwork going forward. And lastly, they're also bullish on Devyani on the back of the fact that a potential merger with Sapphire could unlock significant value not only for Sapphire but also for Devyani, and given the fact that Sapphire has seen a re-rating but Devyani has still not seen, so a merger could lead to a re-rating in the valuations of Devyani as well going forward.
Thank you, Somit, for that. Sharmila, let me come to you. Let's leave aside the three IT companies that Bernstein is positive on. Let's look at delivery. You have Renew, Paytm, Max Financial, as well as HDFC AMC, Jubilant Food and Devyani. If given a choice, which would you advise investors to buy out of this?
So I was actually just trying to wrap my mind around what their thinking process could have been. And as you mentioned, I think, if you remove the IT names, a lot of these seem to be sort of domestic focused themes. I personally like delivery and HDFC AMC within this list. because I think that mutual funds as a business have a long way to go, and we can look at the other names as well in this space, but HDFC AMC certainly leads the way. So HDFC AMC, and I sort of agree with their whatever analysis of delivery. I think that once this is the kind of business where there is a lot of scalability in the Indian context, and you could see better revenues and numbers from them going ahead. So these could be two names that I would like.
Interesting names coming in where Sharmila is positive on as well from the top picks that Bernstein has pointed out. But moving on, Zee Entertainment, that is one of the interesting stocks to focus on in today's session. Look at the stock price at the day's highest levels with gains of 9.5% coming in there. Now, the reason why the stock is buzzing in trade is on the back of the FY26 to the forward-looking guidance that the company has come up with. What they've indicated is that they're planning to achieve break-even in terms of Z5 in FY26 versus a loss of 548 odd crores that they reported in FY25. Their plan is going to be in terms of execution of the business plan and achieve this 100% target. Their maximization of risk-free treasury income is what they would be aiming for, and they would also look at surpassing the highest EPS that they ever achieved in FY19 in the next 3 years. In fact, if you talk about their FY19 EPS as well, that was at around 16.32 rupees. If you talk about 2025, their EPS is at 7.07, so it's almost doubling of EPS in the next 3 years. So that's an interesting target that they've given up. Apart from that, if you talk about their EBITDA trend as well, from FY23 to 25, it's in that 1100 odd crores to around 1200 odd crores kind of a range. In terms of the growth plans as well, they've said they're shifting strategy from long format to short format. They will look at inorganic opportunities in terms of growth through acquisitions as well and strategic partnerships. And what is interesting is the proposed preferential issue, for which they have a meeting with shareholders on the 10th of July, where they're proposing a fully convertible warrant of almost around 2,240 odd crores. Conversion price is around 132 versus a floor price of around 128. And overall, their promoter shareholding will come down somewhere to around 18.5% post this. The company is already sitting on a cash bank of around 2,400 odd crores. Sharmila, strong plans from a Zee Entertainment, 9.5% up move. Is it warranted? Is it achievable? And do you think execution will be the key over here? What would you advise investors to do from a valuation perspective? Good opportunity to buy or no?
Well, I've honestly not looked at the stock for the longest time because of everything that went down there, as well as the fact that I'm not very positive on, the old GEC model that we had. But, clearly all companies are now moving to whatever the stack model or whatever, where they try to incorporate OTT offerings with presence on web, etc. So I think that now, to my mind, makes more sort of sense going ahead than being, just a pure play GEC. So they definitely have some disadvantages because, even when you're present on the OTT space, how are they going to create the content? How are they going to finance it, etc.? And I think that this stock has already seen a run-up from the sort of low prices that it was trading at, where probably people put faith in this sort of story to unfold. So I think a lot of positives are now in the price. So I would really honestly just stay away at this point and see if clearly, as you said, that the story will be whether they're able to deliver, and if they do, then I think there could be opportunity.
Thank you so much, Sharmila, for that view. Well, from one realty ancillary to another, in the latest, the Bureau of Indian Standard Certification implementation for PVC pipes have now been pushed to December. Let's get in Puneet to understand how this is a negative for organized players.
Well, thank you for that. So definitely it's a key negative for all the piping players, and that's largely because the BIS standard was expected to start implementation from sometime in July. Now that has been pushed to December of 2025. The BIS implementation is largely, it's a Indian standard, the Bureau of Indian Standard, that ensures quality products are supplied in the country. Once any kind of sector or product gets a BIS standard, that kind of becomes the benchmark of the industry, and that weeds out all the unorganized or the weaker players, and that largely helps the organized players. So if this was implemented for PVC, which is polyvinyl chloride, a key output and a key raw material for piping companies. If that would have been implemented from July, we could have started seeing the benefit of organized player gaining market share from this year itself. Now that has been pushed to December, while still a positive of implementation, is still delayed, and we could only see some meaningful impact on the financials in FY27. So we've seen some stocks recover actually from the day's low, because while the companies had mentioned about this and the implementation in July, there was some expectation that this could be delayed, and it's because similar industries and products like within something like a furniture or timber has also seen BIS implementation delayed almost 2 times over the last few years. We've also seen another one aspect which is anti-dumping of the said PVC product from China. Even though the BIS standard would be set, there would be still some dumping of cheaper raw materials from China, and I think the key industry players like Supreme as well as Astral are watching out for this aspect as well.
Thank you, Puneet, for getting us the details. In fact, Astral is trading under pressure. Supreme is interesting. If we can just pull up the intraday chart, because the stock was trading under pressure but has seen a smart recovery from the days, now trading pretty much in the positive. Sharmila, a quick one. Supreme Industries, Astral, 2 stocks that probably get negatively impacted on the BIS getting shifted further, and that's especially with regards to the inorganized market as well. How would you advise investors to look at these counters?
No, I would continue to be positive. I think it's a negative for sure that this decision has gotten delayed, and one hopes that it doesn't get postponed beyond December of this year. But if you're just looking at December of this year, I think, given the kind of interest and demand that we've seen for both Supreme and Astral and their numbers, I think I would continue to stay positive for the bit. If it corrects a little more, maybe it will give us an opportunity to buy. But let's just put them on our watch list for now on the back of this news and see if they sort of trade lower than where they are currently.
Right, thank you for that view, Sharmila. Well, time for a quick break. On the other side, we'll bring you all the stocks actions along with a chat with Biocon management. Stay tuned to NDTV Profit.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Imports become the exception rather than the norm, and increasingly we do almost last year, for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true, and today private industry can really increase their involvement in R&D.
I am very proud to say that we make, in our categories that we have been supplying to our defense forces, some of the best platforms in the world.
Markets recover from day's lows, still trade in the red. Nifty, Sensex show resilience despite Iran-Israel tensions escalating.
And Auto Wings Power, HAL and Bharat Electronics, while Zentech acquires 54.7% of majority stake in TISA Aerospace, stock up over 5% in trade.
And IT continues to be on the back foot. Infosys declines over 2%. HCL Tech under pressure. Brokerages rule out worsening demand on the back of Accenture earnings.
Zee Entertainment plans to achieve break-even in Z5. stock up over 10%, also proposes a preferential issue of fully convertible warrants worth 2,237 crore.
And Tata Capital's 17,200 crore IPO gets a SEBI nod. Company filed for confidential DRHP and is expected to file updated DRHP publicly soon. Welcome back. You're watching Profit Buzzers. Varsha, an interesting recovery that you're seeing with regards to where markets go, especially with regards to broader markets. Let's just very quickly pull up Nifty 50, Bank Nifty, Mid Cap and the Small Cap Index, and that will tell you the kind of recovery that you're seeing. There you go. We are still hovering around that 24,950 mark. Let's pull up the broader markets. Mid cap 150 and small cap 250 at the day's highest levels, 0.4% higher on that front. So good recovery there. Small cap 250 as well at the day's highest levels with gains of around 0.6% coming in there. So it's the broader markets which are actually showing strength as we speak. But moving on, Adani Enterprises, that's the stock to focus on as well, because they've gone ahead and commissioned India's first off-grid green hydrogen pilot plant, and this is marking a major leap in clean energy innovation and setting the pace for India's green hydrogen revolution. If you see what they are doing, it's a 5 megawatt capacity plant in Kutch, Gujarat. In fact, this is a milestone towards enabling India's green hydrogen mission, and the plant is 100% green powered by solar energy. It also has an integrated battery energy storage system. What they said is that they aim to become world's largest producer of green energy, and they are developing an integrated ecosystem for the same. This will entail renewable energy, electrolyzer manufacturing, and downstream products like ammonia as well as methanol. Overall, in terms of expansion plans, they are targeting 1 million ton per annum by 2030 and a potential expansion to 3 million ton per annum by 2033. So the stock is up around 1.5% as we speak. Let me also welcome in Amit Bhuptani from Nirmal Bang Securities, and we already have Sharmila. Amit, let me take my first question with you. In terms of Adani Enterprises, what are charts indicating?
Yeah, good afternoon. So if you look at the Adani Enterprise, counter is looking positive. There is not much of a negative update on the chart specific front. Currently, the momentum is there in the counter. New long position can be created at this point of time. The breakout for the stock is at 24.95. Once the 24.95 is getting broken out, then we will witness another 40-50 points momentum on the upside levels.
Thank you, Amit, for that view. Well, green ammonia tender, so the Solar Energy Corporation has came out with green ammonia tender, wherein the goal is to decarbonize India's fertilizer sector by supplying 7,24,000 tons annually to 30 plants. Now, this falls under the site scheme with bids due by June 26, 2025. This initiative significantly reduces reliance on imported natural gas and lowers CO2 emission. Well, two sectors which are in focus, which will be in focus. One is you have the potential bidders would be you have L&T Energy Green, you have Adani Green Energy, you have NTPC Renewable Energy, which may bid for this green ammonia tender as they are already into green hydrogen. Well, fertilizer companies will also be in focus. You have Paradeep Phosphates, you have Coromandel International, then Fertilizers and Chemicals Transfer, Deepak Fertilizers and Chambal Fertilizers, which all these fertilizer companies will also be gaining in trade today. Sharmila, let me come to you on this. Your view when it comes to green ammonia tender and also the L&T Energy Green or Adani Green. What are your views when it comes to specifically on the green hydrogen and also the fertilizer sector as well?
So, I don't have a specific view on green ammonia as such, but what I have been liking and been observing is that there is a whole push towards anything that is renewable and green, and market is also liking that as a story. I think globally there is a great demand for such stories and plays, and we are seeing that play out in India as well. So definitely positive on all the three stocks that, Larsen, I think it's a subsidiary, Larsen Green, but the other two, Adani Green as well as NTPC Renewable Energy. I think I would probably add which are not related to green ammonia, but even stories like a Suzlon or a Wari Energies to it. But that is a basket I think that I like and which market also likes. And overall, even the traditional power space is something that I like. So, overall, this is the sector, and renewable energy within that as a sort of parallel sector is definitely is something that I like.
Right, thank you for that view. Well, Amit, coming to you, any of the stocks looking good on charts? You have, NTPC Renewable Energy, then you have Adani Green, and also some of the fertilizer companies like Deepak Fertilizers and Coromandel.
Currently on the energy front, we are seeing that on chart specific structural wise, it's looking a positive sign being witnessed on the overall energy pack, but still 1 to 2 days will get more time period for the confirmation on the buying front. Currently, if we need to select any positive sign, then NTPC looks positive, while from the fertilizer space, the counter that looks positive from our end will be Chambal Fertilizer. The stock has created a base formation on the downside, with the 4-week base has been created on the downside, and a possible breakout has been witnessed in today's session. So currently Chambal Fertilizer looks more positive in front of the overall fertilizer space. Currently on the upside, the counter is showing targets near 590 levels.
So that's with regards to where the fertilizer stocks go, and an interesting move with regards to the tender that will be coming in for green ammonia. But moving on, defense is on absolute high right now. Idea Forge, they've received an order. So strong moves there, around 137 odd crores. BL has also bagged a new order worth almost 585 odd crores for defense systems. HAL, they've won a bid for manufacturing small satellite launch vehicles by ISRO, and Zentech has acquired majority stake in TISA Aerospace. All of them buzzing, and there is a sentimental up move as well for the sector. Amit, what are charts indicating? A further upside, still a good buy?
Definitely, more good buying will be witnessed, and carry forward buying will be witnessed in the overall defense spec, because if you look at the overall setup on the long-term structure, then majorly charts are showing the flag pattern formation breakouts with a healthy volume, which we are seeing currently in today's session also, and from last 2 weeks of trading session also. If we need to select any counter, then HL, BL and Garden Ridge Shipment looks positive. Overall, if we look at the BL also, then the possible upside targets for the coming days of trading session will be around 445 to 460 levels.
Right, thank you so much for that view, Amit. Well, LT Foods is in focus. The stock is down almost 8% if I'm not wrong. Well, now this is on the back of US, which has imposed 340% of countervailing duty on its units exports. The duty is on Ecopure, which is a subsidiary of the companies. So duty is on the organic soya bean meal. And the duty generally is linked to not providing necessary information by the company, while company is currently evaluating all the possible legal remedies. Quick question, Amit, how are charts looking when it comes to LT Foods?
Showing more negative strength. Currently, the selling which we have witnessed in last 2 days of trading session was completely with the volume front. So this is a negative indicator. Currently, the counter can drag downside towards 375 to 370 levels. So currently, whomsoever is holding the long portion should exit at this point of time. And if a counter is holding 370 level, then we can create a new long portion at that point of time. But at this point of time, I am seeing more selling to be witnessed in coming days.
Thank you so much for that. Well, Sharmila, any views on LT Foods?
I was just trying to see what is the percentage that they actually export to the US, because I'm not clear on that, because this rate of duty sounds really absurd. So, I mean, definitely if their export is substantial, you will see the stock trade lower even from where it is at the moment.
Okay, so that's with regards to where LT Foods go. But let's quickly look at few of the volume buzzers. We've already discussed few of the stocks, but Alkyl Amines is a smart one. Volumes are up almost 7.2 times its 30-day average. And you have 2 sell ratings on a fundamental perspective versus 1 buy, 1 hold. That stock is buzzing in trade. VMart is another one. Volumes are pretty strong versus its 30-day average. You have 12 buy recommendations that are coming in on this counter. And it's showing you a 11.5% upside as well from the current market price. So that's an interesting one to watch out for. We've already spoken about Z Enterprises, but again, strong buy calls on that one as well. Idea Forge, again, strong volumes. We've spoken about that one, no major coverage. And a Chennai Petro, 2 sell calls, but the upside is around 15.5%. Volumes are also pretty strong. Amit, between a Chennai Petro, Alkyl Amines and VMart, what would your preference be?
Or if you need to select any counter, then currently Chennai Petro looks more positive. Overall, if you look at the setup from the quarterly front, also the Chennai Petro, V-Mart, and Alkalamin, all the three looks positive. But on the momentum front, I'm seeing that the Chennai Petro is showing more positive strength. The counter can come towards 750 to 800 levels in the July series. If you look at the V-Mart, the pattern which has been created in the V-Mart on the quarterly chart, it's like a cup and handle formation. The breakout for this counter is at 1000 level. Once the counter gives a breakout of 1000 level, then possible upside movement can come toward 1300 to 1400 level. So strength is there, but the breakout need to be done in the VMAT. But if we look at the Chennai Petro is already trading above the breakout level. So long position can be created in Chennai Petro.
Thank you so much for that view. Well, Amazon has entered into diagnostic market. Clearly, diagnostic is growing into double digit. Now, Amazon has launched its first ever at-home lab testing service in India. Now they are actually promising doorstep sample collection in under 60 minutes. Digital reports will be available in 6 hours, and initially these services are available in 6 major cities, that is Bangalore, Delhi, Gurgaon, Noida, Mumbai and Hyderabad, covering over 450 pin codes. Sharmila, let me come to you. Now we all know that diagnostic is growing into double digits, and one of the reasons why Amazon has come into this sector, and Amazon already has the delivery setup and all, and that's the reason if you see Dr. Lars and Metropolis and Vijaya were under pressure. Just wanted your view, how are you taking this news, and do you think over a longer period of time all these big organized players will be affected by this?
In the short term, definitely, because I think that Amazon's entry into the market will shake things up, especially for the metros. Because they would not have entered the business lightheartedly. If they're saying that they're going to do something in 60 minutes, they're going to deliver. We've already seen a sort of a pricing shakeout in this space when larger players entered. When we had that 1mg and others entered the space, we've seen the traditional diagnostic old listed players having to sort of reimagine themselves and get focused back into how they were pricing tests, etc. But I think at the end of the day, what really matters is that this business is growing because all of us are testing more. And even when you go for any kind of ailment, you are always asked to do a list of tests before anybody, you sort of proceed with the treatment. So I think this is going to be a space that's going to grow irrespective of Amazon entering the market or not, and so will the listed players. It will they might get impacted for the short term, but overall I would still continue to be positive on them.
That's an interesting view coming in. But thank you, Sharmila. Thank you, Amit, so much for joining us on the show and sharing your views as well with all the stocks that we've discussed so far. But moving on and staying with the healthcare space, you have Biocon, which has gone ahead and raised 4,500 odd crores via QIP. The stock is trading at the day's highest levels with gains of around 0.8% coming in there. Now, what next for the company? We spoke to Siddharth Mittal, CEO and MD at Biocon. Let's quickly listen in to that conversation that Tamanna had with the management.
Siddharth, let's start with the rationale for the fundraise. Debt reduction, of course, but is that the primary reason?
So let me contextualize. We have a bank debt of $1.2 billion. And we have obligations to certain private equity investors of $550 million, which was the funds which we had taken in to fund the acquisition of the business that we acquired from Viatris in 2023. So the proceeds of the QIP is going to be used to repay some of those private equity investors, including ADQ, whom we repaid already in January of 2025. Now we have a repayment obligation to Goldman Sachs for almost $200 million. And then we have two more investors, Kotak and Edelweiss, where there are certain obligations which are going to come up by end of this fiscal. So the cumulative proceeds of roughly $530 million will be used to repay these private equity investors.
What would your debt level sit at post this?
So the debt level will be still at $1.2 billion because we are not repaying any of the bank debt or the bond debt that we had. So we have just basically what we have done is on a fully diluted basis, Biocon would have held 72% of stake in Biocon Biologics. And once we have given the exit to these investors, we would increase our stake to 79% in Biocon Biologics.
Okay. So, one question that comes to mind, and you spoke about Goldman Sachs specifically, would they not have had the options for the conversion of their debentures in Biocon Biologics? Why would they not be exercising that?
So Goldman Sachs had the option. It was an optionally convertible debenture.
Right.
While the other investors, Kotak and Edelweiss, is non-convertible debentures. But coming back to Goldman Sachs, of course, they had an option to convert it into equity. But today we are also we are all aware that some of the headwinds that we had in the last couple of years because of facility issues, not receiving the approvals, and the growth that the business had, that probably influenced their decision to not convert. Of course, I would let Goldman Sachs comment on what was the rationale for redeeming the OCD and not converting. But today, I think I'll move forward and say that we are very well placed. We have addressed a lot of those issues, whether it was relating to facility approvals, whether it was relating to product approvals, whether it was relating to gain in the market share for various products in the US or other markets, and coming back to the growth trajectory. So I think we are very well placed. And I think the QIP or repaying some of these investors, as I mentioned, give us the opportunity to increase our stake in Biocon Biologics, which can then be unlocked at a much better valuation in the future.
Okay, is it also in part because, the Biocon Biologics IPO was expected, then there was a clarification or there was some clarity coming in on your last call that might not be the case, you're reviewing it. Can you just give us a status check, Mr. Mittal, on what's happening with the Biocon Biologics listing? Is that still in the offing?
It's still in the offing as one of the options. Okay. But as you rightly said, that Biocon Biologics IPO was being discussed since many quarters. And given that there was a lot of concerns in the equity market regarding IPOs in the last couple of months, the board constituted the committee to look at what are the other options that they should look at, including a merger between Biocon and Biocon Biologics. I think that is also one of the options. The committee has been constituted. The committee is having discussions internally along with other bankers as well, and will make a recommendation soon to the board in terms of what is the best option to unlock the value for both the shareholders of Biocon and Biocon Biologics.
Okay, so this is still a work in progress in that sense. Just want to get a sense on your entire debt reduction focus. Is that a focus area? Is there a sort of a glide path to debt reduction that you have in mind, Mr. Mittal?
So, of course, you have debt repayment obligations, and 800 million of bond is repayable in 29, and the remaining $350 million of bank debt starts. The repayment starts somewhere in calendar 27, but majority of the payments are due on calendar 28 and 29. So if you look at near to midterm, that debt reduction is not really a big burning issue. And what is more important for us is to generate free cash flow, get back to the growth levels that will support these debt repayments as and when it starts.
Okay, so that's strategically you're very clear about that. You've also talked about launching 5 new biosimilars next 12 to 18 months. Can you give us a status check on that? Or, what are the kind of timelines you're looking like? What's the opportunity size?
So we've recently announced a launch of biosimilar ustekinumab in the US. Of course, the ramp up would take its own time, but at least we've got a very good formulary coverage in the US. We are going to be launching biosimilar bevacizumab in the US in the coming few weeks. We are also expecting an approval for biosimilar Aspart in the US. Now that the facility is cleared, again, that product will come up for launch this calendar, hopefully. And apart from that, we have also spoken about approval that we have in the US for biosimilar aflibercept and a settlement that we recently announced, which will allow us to launch the product in the second half of next calendar year. And we have a couple of other filings which are under review with the FDA. So with all these things, we are, of course, quite confident that, with the growth of our base products and these upcoming launches, we should be in a very good growth trajectory in the coming years.
What is the kind of market share you're seeing for Stelara? And the other biosimilars that you mentioned, I don't want to mess up the pronunciation, so I'm not going to try. But the two that you mentioned, Mr. Mittal, what are the kind of market shares in the US market that you're looking at?
It'll be a bit premature for me to comment on the market share. As I said that we have got a very robust formulary coverage. I think that's the starting point. If you do not have a good formulary coverage, then you can't even commercialize your drugs with those customers. So today, at least, we have been listed in most large formularies, almost covering 70% of the lives in the US. And of course, the contracting has begun, and over a period of time, we'll also have to see how the push down happens, because each of the formulary might have one or more biosimilars or also the innovators. So how each company fares within that formulary is something that we'll see over a period of time. But I must remind you, unlike generics, where you see the coverage or market share build up for generic companies in a very short period of time, for biosimilars, it does take anywhere between 12 to 24 months. So I think we'll be in a better position sometime by end of this calendar / early part of next calendar to see how we fare. Now, the only thing I can say is that if you look at the other products that are already in the market, like biosimilar Glargine, where we are close to 20% market share, or biosimilar Pegfilgrastim, where we have the highest market share, almost at 30%, or biosimilar Trastuzumab, where we are almost 24-25% market share. I think that just demonstrates a good coverage that we have got in the US. Whatever efforts the commercial teams, market access team, they've been able to deliver post the acquisition of the business from Viatris.
And what about the liraglutide launch in the US? Is there any visibility on that?
Well, we definitely have a visibility of liraglutide launch in Europe, we already have the approval. The launch preparedness is going on, and we'll be launching in various markets next quarter. And US, the product is under review with the FDA, and we have a target action date coming up next quarter. And we are hoping that we will receive the approval. And depending on our settlement with the innovator, we will be preparing for the launch sometime this fiscal.
Well, this is Biocon Biologics, rather Biocon, giving an outlook for future years. But I'll just share 3 or 4 key takeaways from this interview. They're going to generate free cash flow. Rather, free cash flow generation is the main focus for them. They're also looking for various options, when it comes to Biocon Biologics, because IPO was on the cards, but now they're looking for other strategic actions. Maybe they're going to merge Biocon Biologics with Biocon.
But they're saying it's still under consideration right now.
It's under construction, yeah. It's still under construction. Maybe the merging may happen, we don't know. And also, the other point is when it comes to GLP products, which is the current hot topic when it comes to pharma. So they are going big when it comes to all the GLP products. You have semaglutide and liraglutide as well.
And you have Novo Nordisk, which is leading the race right now as well. So that's an interesting conversation so far. But before we wrap the show, let's just quickly take a look at what the markets are watching out for right now, because the recovery that we are seeing is pretty smart in terms of the broader markets as compared to the benchmarks. But it's the selling that is probably getting absorbed in the markets, and that's the key aspect that we are watching out for. Secondly, Nifty, that broad range, if you look at the key trigger levels, 24,400, 24,500, moving on to 25,200 and then 25,300. These are the 4 crucial levels that the street is watching out for in terms of the range as well. Now, the indication is that probably a new round of panic that could likely emerge, and that is only if Iran retaliates against the USA. Until then, probably there will not be any panic situation, is what the experts are indicating so far. In fact, if Nifty has to break upper range, if major steps are taken at the GST Council meet, is what everyone is eyeing. The dates should be released anytime soon. So that is going to be a key thing to watch out for, where rates rationalization will be key with regards to where the GST Council meet goes. And no panic till Brent crude does not break $80 per barrel mark. So that is also another indication the street is watching out for. In fact, there is monthly derivatives expiry this week. So that volatility is the key indicator. VIX is going to be interesting to watch out for, and whether there is buying emerging as well. And the GRM movement will bring focus to stocks like MRPL, Chennai Petro, ONGC, Oil India, as well as Reliance Industries. So these are a few of the factors that the street is watching out for from a market's perspective. But completely out of time. With that, it's a wrap on this edition from Profit Buzzers from Varsha, the team that put the show together, and myself. In fact, lots more lined up on the other side. It's a half an hour of IPO coverage that you should be bracing for. Please stay tuned to NDTV Profit.
That's huge. That is a biggie. It's out of
गोल्ड ग्लास क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर।
Sources in ED seeking explanation on Yuvraj Singh, Harbhajan Singh, on why they are endorsing such platforms which are banned by Government of India, and the mule account and Benami transaction, the kind of promotional payout being given to some of the media houses, the ad rates are between 50 crore to 100 crore.
What happens in reality is that under the garb of skill-based game, they end up promoting gambling only.
27,000 crore is what the tax evasion, the top popular betting apps are actually evading. Between January and March alone, they have seen 1.6 billion of traction.
Imports become the exception rather than the norm, and increasingly we do almost last year, for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true, and today private industry can really increase their involvement in R&D.
I am very proud to say that we make in our categories.
Hello and welcome to NDTV Profit. You're watching IPO Adda, and the company in focus for us is Indo-Gulf Crop Sciences. The company is coming out with an IPO which opens on June 26, closes on June 30th, price between 105 to 111 rupees per share. It's a fresh issue of 160 crores and OFS of 40 crores. So a total of 200 crores, and the company is valued at little over 700 crores at the upper end of the price band. And joining me today is Sanjay Agarwal, who is the managing director of the company, and Mr. Manoj Gupta, who is the chief financial officer of the company. Gentlemen, thank you for joining us on NDTV Profit. To begin with, Mr. Agarwal, give us a sense of the kind of work that you do, the manufacturing you do in the crop sciences business, because what we understand is that you manufacture products for crop protection, plant nutrition and biologicals which are used in the agrochemical industry.
Yeah, good morning, friends. So, Indogulf is basically into manufacturing and export of agrochemicals. And agrochemicals has two broad segments. One is crop protection and one is crop product. So we are into both the segments. Crop protection, we have herbicide, fungicide, insecticides, plant growth regulators. And in crop productivity side, we have biologicals and nutrients. So we have a integrated basket of product, and in our technical basket, we also manufacture technicals as a part of our crop protection business. So we have around 70 registrations with us, out of which we produce some 10, 12 technicals. We also import some technicals. So our basket is a very comprehensive basket, serving to B2B, B2C, and overseas customers.
Mr. Gupta, you're raising around 160 crores in fresh equity. What is it going to be used for?
Out of this 160 crores, 65 crores we have used for working capital. 14 crores is for my new plant, DF plant is coming, and 34 crores loans repayment we are doing. 12 crores is basically for the issue expenses, and balance is the general corporate purpose.
Mr. Agarwal, you spoke about the fact that you do B2B and B2C business as well. What is the kind of outlook that you have for this sector? Because you've been growing on a top line of really 6.4% on a CAGR basis, which is compounded annual growth rate basis for revenues, and profits are growing at 3.5% on a compounded annual growth rate. So what is the kind of outlook of growth that you have for growth you have here?
See, all these three verticals have different opportunities. So our main focus is on our brand business, and especially for the India market. And in our crop protection, there is a segment of biologicals and nutrient, which is one of our legacy business. And when we started this company, one product which is a micronite nutrient deficiency corrector, that was our initial products. So we grew over 3 decades, and biologicals and the nutrients will be the major focus area, because these are the upcoming market and emerging products. We are more focused on brands. Also, we have overseas business, and in overseas business, we have been working in 34 countries. Many registrations are still in pipeline. Our business is a regulated business, and it requires sometimes to get the registrations, and we are doing well. However, overseas is not our major part of the business. Brand business is the major part of the business. We also do B2B, which is basically technical business, and this adds value to the barter purchase and the supply chain management also. Our commitments and our deliveries are the base for this B2B business, and we are doing well. However, for our future growth, we plan to expand our brand business more aggressively. Very recently, we have added one wholly subsidiary company by the name of Abhiprakash Globus Private Limited, which is a wholly subsidiary of Indogulf Crop Science. The objective is to increase the reach and increase our brand business, our B2C business.
Since you said it is a regulated business, can you give us an idea? Do you depend on subsidies, reimbursements coming from the government?
No, we are not into like bulk fertilizers or any such kind of subsidies. So it is a private channel, and we have over 6,000 distributors. We have around 200 channel partners for B2B business, and more than 130 business partners overseas.
Mr. Gupta, can you comment on the margin picture here? Because you had a margin of 10.7% EBITDA margin in FY24, but for the 9-month business, it is 9.36%. Is there a reason why margins have contracted for the 9-month period?
Numbers are actually for 9 months. Basically, when we go in the 12 months numbers, it will be much better. But yes, if you will compare with as comparison to last year, we have done the equal margins. So last year with the 9 months number, it was 9.5% and it is again 9.3%. So there is not a much, but yes, we have the growth in the PAT margins, which was in last 9 month numbers, this was 4.1%, but this year it is 4.6%.
So is there a cyclicality in your business?
Well, that was the management of Indo-Gulf Crop Science. So, but it's raining IPOs. Ellen Barry Industrial Gases IPO is also set to hit the Lal Street on June 24. My colleague Sajid spoke to the management as well. Listen in.
Give us a sense of the kind of industry that you're in. What is the business structure that you have, and what are the business verticals that you have?
Okay, we started with air separation gases, that is oxygen, nitrogen and argon, and that remains our mainstay. Other than that, we are also manufacturing a number of other gases and distributing some, which are quite synergistic to the main business of air separation gases. The customers are generally the same. Other than that, we have businesses in terms of EPC. We make complete plants for air separation and related equipment and directly sell them, or we also supply to them, to our customers on long-term contract basis with operation and maintenance being done by us. We also have business in healthcare, which emerged mainly out of the needs arising from COVID, and we do hospital pipelines and turnkey supply, total gas management with regard to the hospital ecosystem. So these are generally the main businesses in the company.
Varun, can you take us through the 400 crores that you are raising with respect to how you're going to use it?
Sure. So the 400 crores is primarily for three purposes. The first is to set up a greenfield expansion plant of 220 tons per day in eastern India. This plant is located adjacent to one of our existing units, which is running at 100% capacity. So there is a need for capacity increase there. Another significant portion of the proceeds will go towards repayment of our debt. And lastly, about 100 crores out of the 400 would be towards general corporate purpose.
Mr. Agarwal, can you give us a sense of the kind of market we are in? Because you are eastbound, which is with major facilities coming in West Bengal. How big is that market for growth?
Gases are everywhere, and the market generally anywhere would grow faster than the rest of the industry. There are no published numbers in terms of the market size, but we see generally a growth exceeding 10% in all geographies. Yeah, we are strong in East and South India, but at the same time, we also cater to customers in the rest of the country.
And how do you transport these gases across the country? Because transportation is the biggest thing for gases. So how do you do that in that sense?
So, we have three modes of delivery to our customers. The first mode of delivery, which is the most important in terms of our revenue contribution, of about 2/3 of our revenue comes from delivering liquefied gases to our customers. Here what we do is we liquefy the gases in our plants and then transport it via tankers, which are owned by the company, to the customers' factories. Liquefying the gases allows us to reduce the transportation cost drastically. So it's sort of similar to, like how natural gas is liquefied into LNG and then transported. So that's about 70%. About 15% comes from supplying in cylinders. And these are cylinders you've probably, all of us have seen, probably in a hospital or in any sort of a small factory. However, the cylinder supply radius is quite limited because there the transportation cost is quite high. And the third is, where we call it the on-site model. And here what we do is for our very large customers, we set up our manufacturing facility